I want to personally thank you for buying the tapes and for sitting with me the next 6 or 7 hours of learning about the market. What I want you to mostly know is how good I feel about these tapes, because this is being taped now over a year from when the tape was made that you're about to see, the learning tape. And in that ensuing 12 or 13 months, a couple of thousand people have gone on the journey that you're about to go on. Those people have written me, they've called me, they've faxed me, and a lot of them have made a great deal of money, $10,000, $20,000, $30,000 from what they learned on those tapes. Now, the people that did that got the most value out of the tapes, tell me that they watched the tape a couple of times, they read the book a couple of times, and when they had questions, they faxed me or they called me. And at the end of the tape, you'll have my fax number and my phone number. But most importantly, the people that have prospered the most from these tapes, I find, are the people that didn't get into the minutia of just charting and the little things, but the big parts about the market. When I talk about commercials, listen up. That's terribly important. When I talk about contrary opinion of the public and open interest and spreads, that's the stuff that moves the market and makes the markets forecastable. And if you really pay attention to that, you're going to catch the big things, and the little things, I think they'll take care of themselves. So continue the journey, watch the tapes, and I hope that on this journey you'll encounter the same type of success that Larry Williams has.
I started with Larry about 1.5 years ago, and he's given me a lot of information that's helped my trades. Previously I was not profitable, and he's helped guide me in directions that have increased my profitability and helped my trading.
My experience has been much better since I've met him.
You'll walk away with stuff that's tradable, but you'll also learn how to find your own tradable stuff by looking at these patterns.
He's the ultimate system developer. He's creative. He's an exceptional trader. He's well disciplined, but he's multifaceted.
He talks very simply. He doesn't act like he's a know-it-all or some type of expert. He simply has found certain things that seem to work all the time. I think he's a pretty good guy.
There aren't very many people that can accomplish what Larry's accomplished in his time within the markets. And it just feels so good to be able to learn from somebody like him.
The more exposure I get from Larry Williams, I think the better off I am, you know.
Hi, I'm Larry Williams. I'd like to welcome you to my video series on how to trade commodities. I'm going to try to teach you from the very basics, the very beginnings of what the commodity markets are, how they work, the difference between stocks and commodities, so you have a groundwork and an understanding of the marketplace. I'm going on the assumption for this first hour of videotape at least that you probably don't know much about commodities, in some instances maybe nothing at all. I'm going to try to truncate your knowledge and give you a compact version of what you need to know so you can get trading. I'm going to explain who the players are in this market, what the playing field is, how we go about predicting the markets, and the basic terms, because without the terms of this business, without the trade knowledge of how to place an order, how to deal with a broker, obviously you're not going to be able to trade. So this first hour is going to be to bring you up to speed. Then in the next tape we're going to get into how I predict the markets, how I can tell if a market is set up to go higher or lower, and the best indicators that I have, 7 of those indicators I'll be sharing with you on the tapes, as well as timing, because it's not enough to just select a market that's going to go up or down. You also have to time your entry into it. Then you need to control your risk. And speaking of risk, I want to make it clear that there's no guarantee in this videotape or anybody's that you're going to make money trading commodities. This is a business, trading commodities, and let me tell you, it's a risky business. About 80% of the people that trade probably lose. The only sure bet that I can tell you as an investment strategy to make a lot of money, to double your money for sure, is buy a Yugo car and you can double its value if you fill up the gas tank. Short of that, there's no guarantees in the investment world that I know of. It doesn't matter if it's stocks or commodities or real estate. All this is inherent with risk. And I think that's great. I think it's fun to have risk in your life. Now, if you can appreciate that statement, then you're probably going to be a good commodity trader. But if risk scares you, turn off the tape. You know, rewind it, send it back, because risk is really an exciting thing to have. We need to learn to control that risk, and the risk is a financial risk and an emotional risk. I'm going to talk a lot about that control of the emotions and of how to control the financial risk, So we're not playing with unlimited risk, but without some risk in life, there's not much rush, there's not much thrill. And commodity trading can be thrilling. We just need to cut back and establish that thrill level so it's something we can live with and continue to trade. So we'll handle that for you as well. Well, that should get us started. I'd like to first talk about the differences between stocks and commodities, because there's a big difference between stocks and commodities, a huge difference now versus when I started trading stocks. I first started following stocks in 1962. Back then there were maybe like 800 stocks, and now there's maybe 20,000, 30,000 stocks in this country and around the world that you might be interested in buying. So your universe is gargantuan. What stock do I buy? Whereas in commodities, it's still the same old wheat and pork bellies and corn and gold and silver. Our universe of what to look at is very, very small compared to a 20 or 30,000 universe of trying to select one stock out of those 20,000 stocks. That's tough. That's real tough because the sample size is so large. Whereas in commodities, not only do we have very few to look at with the tools and techniques I'm going to show you, we can bring that down to even a smaller number of the markets that are set up now to trade, to go up or to go down. So we can really get this honed in to a narrower viewpoint for us to look at. And that alone makes, I think, commodity trading much easier. The other thing I like about trading commodities versus stocks is stocks go up because of a myth. The primary motivating factor for higher stock prices has always and will always be earnings. When a company makes more money, i.e. they have an earnings increase, the price of the stock goes up. That's the bottom line to trading stocks. But there's no true supply-demand for stocks. Nobody needs a share of IBM or a share of General Motors. What can you do with a share of General Motors? It's a piece of paper. Now, you can put it on your wall, you can frame it, you can say I bought it at a low price and sold it at a high price, or vice versa. Most people it's vice versa. But you can't do anything. There's no intrinsic value. You can't take that share of General Motors and walk up to the company and say, I want that tire off the car over there because I own stock in General Motors. So the only supply-demand of stocks are mutual funds buying and selling, or the public buying and selling. But think about commodities. Think about corn. Is there a real demand for corn? Does somebody really need corn? Yeah, you bet. Wheat? Sure. Cocoa? Coffee? Gold? Absolutely. You've got to have gold for so many electronic processes. So there is a true supply-demand market to commodities, and that gives us a real advantage, because with that real supply-demand, we can then follow the supply-demand in the commodity market much easier than we can in the stock market. And that gives us an insight that we simply can't get in the stock market. In the stock market, all we can really do is monitor earnings and dividends and what insiders in the company are doing. Are they buying or selling their stock? That's the fundamentals of the stock market. The fundamentals of the commodity market are the people that need the commodity on the supply or don't want the commodity on the supply-demand ratio. So we're going to work a lot with those supply-demand ratios, and as you'll clearly see, they're very predictive and show when a market is set up to be a long or to be a short. A couple of other differences. A share of General Motors is a share of General Motors. But when you are long a contract of, say, wheat, there are contract specifications for that wheat. It must have a certain protein content. It must have a certain moisture content. It must have a certain mineral content. So that is a deliverable grade, is what we call it, a deliverable grade contract that the Board of Trade or wherever this commodity trades has a specification. It must be this quality of wheat. It can't be bad wheat. It can't be a real soft wheat. It's a red wheat or a soft wheat or a hard or whatever the protein content is how we measure the various things. You hear a pork belly contract. People like to laugh a lot about pork bellies. It's always made a joke of in sitcoms and movies and everything. Pork bellies are the underside of a hog. They're slabbed off. They weigh about 18 pounds on both sides. They're put into cold storage, and then they're brought out, and we make bacon out of it. And that must have a certain fat content, a certain meat content. So we have a stabilization to what a contract is. A contract of gold is 5,000 ounces or 1,000 ounces, depending on the size of the contract. These items are actually delivered to somebody, does take delivery, or they take physical possession because they're going to use it. Whereas you can take physical possession of that share of IBM, you can't do much with it. But in fact, a lot of people just have their bank hold the stock for them. But a user, an end-run user, will take the wheat or the corn and take physical delivery of that commodity. Now that's an interesting word, physical delivery. You'll hear people use the word physicals in this business, and that means the actual commodity itself. The physical contract, or the physical is the commodity. What we trade are contracts. Now these contracts expire, unlike a stock where Xerox trades forever. Pork bellies or wheat or gold is a contract of a specific time period that has a quality to it, how many ounces or protein, etc. And it expires at a certain specific time period. I'd like to show you when those time periods are so you can get a sense of how that works. We'll look at our overhead projector, and first of all, let me show you the exchanges that we trade on. The vast majority of commodities that you're going to be trading will be on the Chicago Board of Trade. Most of these boards or exchanges are in Chicago. The Chicago Mercantile. The metals are traded primarily on the COMEX. That's a New York market. And also in New York, we trade coffee, sugar, and cocoa. Cotton is traded on the New York Cotton Exchange. The IMM, the International Monetary Market. And then we have the smaller markets, the Kansas City Board of Trade. The Mid-Am, this is interesting. The Mid-Am is a very small market where the contracts are a much smaller margin than, say, the Board of Trade. A margin in the Board of Trade might be, say, $5,000, and on the Mid-Am it might be $500. So if you don't have a lot of money to trade with, you'll probably start trading in the Mid-Am markets. Then you've got the Minneapolis Grain Exchange and the the New York Futures Exchange. And finally, you've got the Winnipeg exchanges. These are the different exchanges where these commodities are traded, but primarily they're traded in, the big contracts are traded in Chicago on the Board of Trade, and the Merc, where the meats are traded on the Mercantile Exchange. Now, as I mentioned earlier, these contracts actually expire. They expire by months. Not every commodity expires every month. Typically, say in the case of Treasury bonds, the expiration is March, June, September, and December. We have a code. I'd like to show you the code. This is the first inside code you're going to learn for the business. We abbreviate the months with a letter. So January, the abbreviation is F. And if I have, say, British pound, and the symbol here for the British pound is BP, if I had BPF, that would mean British pound January month. So if people will say they're in they may say they're in the D or the Z S&Ps, the month for the symbol for December is Z. So you would know if they say they're in the Zs, they're in the December of whatever that commodity might be. It might be Swiss franc has a December contract. In fact, we can then look and you'll be able to see the delivery months. In the case of the British pound, H is a delivery month, and we see that H is March. M is a delivery month. M stands for June. U is a delivery month. U is for September. And finally, Z is for December. So you can see the months that these contracts expire. There's a real advantage because when these contracts expire, because they can be in real tight demand, people want them a great deal, those markets can be driven by the commercial desires to outperform all the other contracts. So it's very important that we look at the relationship between the nearby contract, the one that's expiring now, and those out in the distance. And we'll get into that and I'll show you how to do that. But I want you to see that we have contracts, they expire, and we can tell at what month that these contracts expire. When they expire, we call it going off the board. It's off the board. It doesn't trade any longer. Now, there's another term. Currently, this is being taped in December of 1996. October 1996. If we were trading, say, the a year away, next December, we would call that the red month. I don't know where the phrase came from, but if you're trading a year out, people will say, well, that's the red month because it's a year away. We're not trading the nearby December. If you're way out that far in the future, we would be in the red or the D97 it would be, as opposed to being in the D96 if that's the month that you were trading. We also have a minimum price fluctuation that these markets are worth. In the case of, let's go in one that's easy to understand, soybeans, the minimum price fluctuation is 1/4 cent. And 1/4 cent is worth $50. And the margin requirement at this time is $1,500 for soybeans. Now this will change. The brokerage firms, the great thing about commodities is you don't have to put up all the money. You can trade a contract of, let's find Treasury bonds here. Treasury bonds, you can trade right now for $2,600, you're trading actually about $100,000 worth of bonds, and you only have to put up $2,600. Oh, that's a great deal. In any other investment that I know of, if you're going to buy a house that's $100,000, you've got to probably put up $20,000. Well, in Southern California, maybe you can put up $2,600 because the real estate market has been a little depressed. And then you have to pay interest on, you put up $10,000 on a house here, and you've got $90,000 you have to pay interest on at 10%. So there's $9,000 a year in interest. That's a lot of money. The house has got to go up in value by that for you to just stay even. In the case of these commodities, there's no interest. You put up a margin deposit. It's not, there's no loan involved. You put up just a margin, and there's no financing like in stocks. If you want to buy stocks on margin, you put up 40, 50, 60% of the value. The brokerage firm lends you the rest of the money. In this case, we're buying a contract, a futures contract, and a futures contract is just that. There's no interest involved. So we really have the best of both worlds. We don't have to put up much, and there's no interest on the difference between what we put up and the face value of the contract. And that's one reason why it's possible to achieve such big results, upside or downside, because on a $100,000 bond contract, let's say the bonds move up 10%, so that's a $10,000 gain on your $2,600. So you've just about tripled your money on a 10% move. By the same token, if it comes down 10%, you're going to lose at some point before you get out. Hopefully you get out before it comes down that much. But that's why we can get such extrapolated gains. A 10% gain in the underlying futures contract can maybe equal 3 or 4 times return on your actual investment that you put up for your contract. So it offers a tremendous amount of leverage on your money, and that's it's a two-sided sword. It's the advantage of commodities, but of course it's a disadvantage if you're on the wrong side of the markets. So you need to learn how to control the wrong side of the markets by using protective stops to protect yourself so you don't lose all of your money on any given one trade. Let's talk about those terms. I've used some terms. I brought some terms in here I'd like to talk with you about. The first one I used is stops. Let me explain what a stop is to you. A stop is your ability to protect yourself against a continual loss. If you've got a market that's moving up, let's say something like this, and you're long this market, maybe you were fortunate enough to buy it there, but now you're starting to get a little leery and say, gee, I don't want to lose. I don't want this market to come down. You can say, I don't want to lose more than this amount of money, and you'll place an order with your broker called a stop, which means, in this case, since we're long, we would sell on a stop at, say, 65 cents, whatever the price is here. You just give that order to your broker. I'll sell one contract on a stop at 65 cents. Now, if for some reason that market comes down and immediately does this, you will be stopped out somewhere in the 65-cent area. So you've limited your potential loss by giving your broker an order that says, I will exit on a stop. If it goes to this price, get me out. So you can protect yourself against risk. Maybe this particular trader was willing to take this much risk. Maybe you bought it at 60 cents and they would take a 5-cent risk. Another trader may say, well, I'll take a 10-cent risk. So his stop would be here. So you can vary your risk by where your stop is. In this business of trading commodities, we're primarily on the offense. We're buying, we're selling. We don't have a lot of defense. This is our defensive mechanism. The first thing I want to talk to you about is defense. The teams that win the Super Bowls are the teams with the best defense. They have to have a good offense. That's what brought them to the Super Bowl, right? But without a defense, they're going to get beat. A defense is terribly important. We don't have a shield in this business to protect ourselves. Our shield is money management, and our shields are stops. So the first term I want you to learn is stops, and that's going to protect us. We'll sell on a stop. Now, if you were short the market, and we'll talk about that in a moment, and the market's coming down like this, you could have a stop above the market to exit your position and get you out of the market. If the market goes up there, your broker has that order actually in the exchange on the floor, and the broker on the floor, if he sees that price, will sell and get you out of your position. So you can protect against your loss in that fashion. A couple of other terms a lot of people aren't aware of. People always, you hear on the news that something is bullish or bearish. I'd like to explain those terms to you. It comes from here in California. Bullish means the market's going to rally, to go higher. Bearish means the market's going to go down. It comes from the old days. Mark Twain wrote about it when in California, instead of having freeway pileups, the sport of the day was bullfights and bear fights. And everybody would gather around at the fairs in the fall, and they'd bring in a bull and a bear to fight. Obviously didn't have television back then, or maybe they would have had MTV instead and watched that instead of bulls and bears. The bull, when the bull fights, would raise his head up with his horns to gorge into the bear. And so that's an uplifting market. And the bear would come down like that on the bull, trying to bring those claws into the back of the bull. So a down market is a bear market. That's where the term comes from. And an up market is a bull market, the bull thrusting his horns to the upside. So if you're bullish, you think the market's going to go higher. If you're bearish, you think the market's going to go lower. And that most people will talk about he's bullish, he's bearish. Now you know what the term means. Bearish means you hope it goes lower. Bullish means you hope that it's going to go higher. One of the really fascinating things to me about the market, stocks or commodities, is that you can make money when the market goes down. Unfortunately, you can't do that in real estate. It'd be great if you could. But there's no way that I know of doing that. If you think a market's going to go down, you can actually make money when it goes down. That term is called selling short. And I'll try to explain it to you. Bear with me on this one. What happens is the reverse. Usually you buy something, right? Anybody ever bought a piece of real estate here? Anybody? Yeah, 1, 2 people admit it. That's good. And hopefully it goes up in value, and then you sell it and make your profit. Selling short is just the reverse. You sell the thing first. Then you buy it to cover later on to replace what you sold. The easiest way maybe of understanding it is like this. I'm going to borrow his soybeans. We'll just use this for sake of argument. And he's happy. I'm going to give him something, whatever. I borrow his soybeans, and I come over here to somebody who wants to buy the soybeans. And he says, yeah, I'll buy the soybeans, Larry, from you for 60 cents a bushel. So I say, here they are. They're all yours. I've now sold the soybeans, but I owe him soybeans, don't I? Hopefully those soybeans will drop to 40 cents. And then I come over here and I buy the soybeans for 40 cents and say, here they are. You got your beans back. Now that's the way it works in stocks. It's a little different in commodities, but it gets the point across, I hope, that I can actually take something that I don't own and sell it over here, because I will buy it back later on to cover the long position, to cover the transaction. So it's just the reverse. Instead of buying first and then selling, if you're selling short, you sell it first and then you buy it, hopefully at a lower price. Now, that isn't always true. If the market goes up, and he was right on the bet, if you will, because beans went from 60 cents to 70 cents, I'm short and I'm losing as they go higher, I still have to buy to cover my short position, and I will then lose from 60 cents to wherever I buy. So I can lose money or I can make money selling short. The classic argument against short selling is if you sell soybeans at 60 cents, they can only go to 0. But if I buy them at 60 cents, they could go to 120, 220, 420, 520, whatever. They could go to any it's unlimited on the upside. But a stock or a commodity can ultimately only go to 0. You can't make any more than that. On a long-term basis, that's really true, but most long-term commodity traders are dead. There's not much long-term in this business. Long-term is maybe a couple hours for some traders, 10, 15 minutes for others, and certainly maybe 2 or 3 months is a real long-term commodity trade. So we're not too concerned about the real long-term commodity trades, and a short seller can make a good deal of money in the market. If the market drops, you can pick up a good lick in the market. So if you're looking for the market to go down, you're going to be a short seller, and you do that by selling something you don't own. You sold it, and then you buy it, and the difference between where you sold it early and where you bought it is your profit or your loss on the trade. So that's short selling. Everybody, I think, understands the idea of buying something, hoping it goes up, sell it, and if it goes down, you also have to sell it and get out and take your lumps. So those are the two things that we'll be doing, buying or selling short. Now there's another position, and this is the most, probably the best position. You can be long a market, you can be short a market, or there's a third position called being flat or no position at all. Wonderful position. You know, you can't lose money. when you don't have a position. Yeah, it's very nervous because you always want to be in the market. You always, I mean, everybody wants to be in a market making money hand over fist every day, so your nerves kind of drive you into getting into positions. It's something we have to contend with all the time. That's one of my problems. I love to trade. This is the funnest thing I've ever found in my life. So I want to be long or short, the same commodity even. And you can't do that. So there is a third position, which is to be flat. And most people don't use that position often enough. I would say that it's better to be flat or no position, to exit on your trade and just sit back and say, what's happening now? As opposed to always being in the market. Invariably, when people have watched this video series and call me up, they will say, they're long this market, they're short. There have been 4 or 5 or 6 markets. They're way over trading and way too many markets, and they want to be every market, every tick. And I just say, it's hard. It's a hard business. This is not an easy business. It's tough to predict the markets. I want to focus on as fewer trades than as opposed to many trades. And it's a very valid position to have no position at all, to be flat. So you'll hear me use that term also. Being flat means we went flat, we got out of the trade. Whether it's a long or a short, we have no position. Our account is flat. It shows no position in the account. So our position will be long, short, or will be flat. We're sitting on the sidelines with no position. And those are the positions that we can have. Now, there are other positions. You can be in an option, and you can be in a spread, and that's a little advanced. For this tape series, I'm going to start with just the basics, and later on you can get into the more sophisticated. But even as long as I've been trading the markets, I keep it really simple. I think if there's any strength or wisdom to what I do, that it's very simple, that I don't try to get terribly complicated in my work. And that's not to say that there's no place to be complicated. It's just that I'm not smart enough to be complicated. And I have enough trouble figuring out if the market's going to go up or down, let alone figuring out options, spreads, strips, straps, straddles, all these other terms that you'll learn about as you progress in the business. I just want to figure out if it's going to go up or down. And I'll focus on that because there's enough money to be made there. If you think the market's going to go up, you could get an option on the market. There you put up even less money. And if the market goes up in value, you're going to make a lot more money. And your loss is limited on the option to you can only lose what you put up for the price of the option. That's the pitch that everybody gives you from the brokerage community. Well, if you buy an option for $500, you can't lose more than $500. If I buy the contract of soybeans and they drop down, I may lose $1,000 or $1,500. So I've got to control my loss in the actual owning the soybeans with my protective stop. But if I go through the stop or I don't use a stop, I could lose more than I put up. And in the options, you can only lose the $500 that you put up or $300 you put up for the option. However, there's a problem there. Let me explain that problem. Options lose value every single day. So while the price of the market may actually be rallying, the option can actually come down because you have a premium in the option. And this premium expires or dwindles away. So you can lose money holding an option while the market goes up. You predicted right. The market went up, right? But the value of the option went down. And I've seen that happen. I was in Chicago not long ago, and I had a signal to buy the S&Ps on a Friday morning and get out on the close Friday, which was an unusual signal for me. And I did it, and somebody said, oh, you should do the option, Larry. So I said, well, let's watch the option today. Had I bought the option on the opening, got out on the close, I would have lost money. As is, I made about $1,700 a contract buying the futures and getting out on the close. I would have made money had I bought a put, strangely enough, and in other words, been short and got out on the close. So I want to keep it real simple, and I'll stay with just the futures contracts, with the exception if I see a major move coming, then you could say, I'm going to buy a couple options in here, or if you don't have much money, you're starting with maybe $1,000 in the market, and you can't afford the margin requirements of $3,000, $4,000, $5,000, $6,000, $10,000, then you could buy an option, but you don't do that every day. You do that when you think you've got a market that's really set to go up. Everything is there, as I'm going to teach you in the next series of tapes. It's all there. All the big guns are there. Then you can take an option. But you want some time because we can't predict exactly when the market's going to bottom. You want some time for that option to work itself into a profitable position. You want to buy those options as cheaply as you can. You don't want to pay a lot for them because you need some time now for this trade to start to rally or for the market to start to go down. And usually when my stuff is set up is when the options are at the best value. So I think the best option is to trade an option for a longer term move. When we get a market, we say, we know the chances of this market going up are high, 80%. Then you can take an option, and your risk is limited to what you're going to put up on. It's probably going to expire worthless. Or you're going to make a lot of money. The interesting thing about options is I think about 90% of them expire worthless. In other words, all the money that people put up expires. So they're losing all their money most of the time. So the fact that the brokerage community will say, or a lot of authors will say, well, you can only lose what you put up if you trade options. That's true. But if 90% of them expire worthless, what does that mean? It means you're going to lose 90% of your money. So it's just a slower way of losing your money. Yeah. I mean, if you're a real masochist, you'll probably want to trade commodities if you're losing, because they're going to happen quicker. If you want to endure the pain a little bit longer, well, then you're probably going to want to trade options. But it isn't the mechanism, the option or the futures contract that makes you money. It's being right on the market that makes you money. Predicting, being able to understand this market should go up, this market should go down. That's what makes the money. It's not the vehicle that makes money. It isn't the option or the future contract. It's, are you right on the market? And that takes thinking, and that takes an understanding of the market, and that's what, of course, we're going to have on the second tape, so you get to understand that. But I want you to know about these vehicles of the different things that are there for you to trade with. Well, let's see what other terms we have to go over. Let's talk about the market itself, what a market looks like. I look at charts, and this is a typical chart. This happens to be the February 92 pork belly contract. I'd like to just show you a few things, and then we'll get even a closer up view of this, and you can see what the markets look like. I keep these charts every single day, have for in my own chart book for, 30-some years now, day after day, of posting these little lines here. And I'm going to show you what's on these lines so you can see what you need to keep. Basically, every day in the market, we're given a set of figures. And the set of figures that we're given, we have an opening price. That's the very first price where the market trades. We have a high for the day. We have a low for the day. And then we have where the market closes for the day. Usually this bar will look something like this. This is the high for the day. That's the low. That's the close. And this is the opening. And on charts, when you see a chart, you'll see it looking like this. Now, if we zoom in on this chart, or maybe I've got a chart that I blew up. If we can zoom in on this chart, we'll be able to see a real tight view of this chart. We can see the high-low closes, maybe right in this area right here. You can see where we have a high for the day, a low. There's where we opened on the left side of that bar, and finally we have the close up there on the right side of the bar. That's the data that we have every single day from the marketplace. That's the data that's used most often by technicians. And I'll talk about technicians a little bit. This is what the actual physical price of that commodity did on any given day. There's some other data that we also get. We get volume. Volume is the number of contracts. In other words, how many contracts traded here on this given day. You may have a day that trades 1,000 contracts, and the next day it trades 50,000 contracts. Volume is an important number for us to look at, because volume is like water in a swimming pool. If there's only 500 contracts trading, that's not much water in the swimming pool, and you can't get in and out easily. If volume is 100,000 contracts, well, there's a lot of players in the pool, and there's a lot of people you can buy and sell from or with. But if there's only 500 of them and you want to get out, they might say, heck with you. Or they might want to get out too. So the market will have wild gyration, big moves, drops to the downside, rallies to the upside. But we call this liquidity. The more volume there is, the more liquid a market is. And you want to trade in the liquid markets. If there's one thing that's terribly important, it's trading in liquid markets. An illiquid market, one that trades a couple hundred contracts a day, 500 contracts a day, you can't, especially if you have any size to your positions, you can't get in and out easily. You may think these tapes cost you a lot of money for a couple $100, whatever you paid for them. Let me give you a lesson about liquidity. I was long propane in 1973 or 74, and at locked limit, I'll explain that term in a moment, it was such an illiquid market that it went down 17 days straight, and I lost $375,000. I couldn't get out of the market. There was no liquidity. That's how much it cost me to learn what I just told you. I couldn't get out. It was just lock limit, lock limit. Lock limit means that, first of all, I need to define limit. The market can only move so many points in a day, and the exchange says it can't move any more than that, and we'll just close off trading. So if a market moves up limit and there's no orders to, it's rallying and nobody is selling it, there's lock limit. It just sits there. And there's nothing you can do. You can't get out. It's locked, and you cannot get out of your position. Now, if you're long, that's great. You love it because you're making money. It should go higher the next day. If you're short, you can't get out of your short position, and you're not loving it at all because you can't get out. And now you're exposed to another lock limit move. Well, the lock limits happen more frequently in the thinly traded markets, in the illiquid markets, than they do in the large gargantuan markets that trade 100, 200,000 contracts a day. So I would like to see you people at least initially stay in the very liquid markets, the markets with a lot of volume, where you can get in and out, and you don't get bad fills, you don't get slippage when you try to buy it. One price, you get close to your price as opposed to a higher price. So stay with the liquid markets, especially as you start. Remember, it cost me $375,000 to learn that lesson because I was trading very illiquid markets. I had traded illiquid markets being long, and they went straight up as well, which was nice. I had some money to pay for the losses. But there's always two sides to that sword. And it's great to be long an illiquid market when it's up limit every single day, but then you got to get out at some point. And that old greater fool theory, you know, once you're long, who are you going to sell your stuff to? There's got to be some turkey out there that's going to take your stuff, right? Who thinks that you're wrong? And if there's nobody in the pit that thinks you're wrong, you can't get out of it. So stay with the liquid markets, and that alone is going to help you a great deal in your trading. I'm going to back away from terms for just a moment because there's an important point I want to make, and I want to make this early on in the video series, and it's this. There are only two ways of making money in the markets. Only two ways of making money in the market. This is critical for your understanding of trading commodities. And the two ways are to either have a small number of contracts and get a big move, or have a large number of contracts in a small move. That's how people trade the market. Very seldom does anybody have a large number of contracts and a large move. Especially for people starting, you're going to want to start with one contract and catch a big move in the marketplace. That's how you make money. As opposed to having big contracts and hoping you'll get a big move, you're going to get too much financial and psychological pressure on you. The person who helped me so much, my mentor, is a guy named Bill Meehan, who taught me so much about the market. So I'm just so indebted to in the 60s. And that was one of Bill's adage. He always said, Larry, you make your money in small moves, small positions, big moves. And then when I became efficient in day trading and could make money day trading, I realized what I was doing was just the opposite. I had large positions in short-term moves. And I'm convinced that's how you either have to be, I'm going to be this type of a trader, I'm going to be that type of a trader. And certainly starting, the day trading and short-term trading, you don't want to do that. That's tough business. It's real hard. It's a lot of pressure on you. You can make a lot of money because you do have large positions and you're in and out of the market relatively quick. But it's so much easier as you're starting and learning about this market, small positions and big moves. Make a lot of money doing that. Most people's investment goal is unrealistic when they come into commodities. Unfortunately, the worst thing I ever did was the year that I took $10,000 to $1.1 million in real-time trading. Really did do that, real money, trading day after day. And now, everybody thinks they can do that. I even think maybe I can do it. So that becomes everybody's goal. Turn $10,000 into $1 million. It's an unrealistic goal. Have you ever had an unrealistic goal and you can't get there and then you feel very frustrated? It would be much better to say, my goal is to take my $10,000 to $20,000. Gee, that's doubling your money. That's better than the funds do. What's wrong with that? Everybody has this grandiose goal of owning the world in 6 months after they get my video course. It can happen. Some people have done that. I have students that have made well over $500,000, $1 million and more. Got one that's made $6, $7 million now. So it can happen, but these guys did not do it overnight. It took them some time. And they also didn't use just Larry Williams. They thought themselves too. And they're intelligent people, and they spent a lot of time working on these markets. but they did not have an unrealistic goal of making a killing overnight. That's too much pressure on you. You don't need that kind of pressure on yourself. You want to master your trade here and then go out and see how you can do with it. That's why I suggest you paper trade first. You don't have to open up a brokerage account. You don't have to have any money. And you're not going to lose anything other than some time, and that's your learning experience. I'll tell you, the people that have the most problem trading commodities tend to be doctors and lawyers. Why? Because they went to all that school. I mean, they know they're smart. And they know if they're that smart to become a doctor or a lawyer, they know that this commodity stuff has got to be real easy. So they get into our business of commodities and they come in with all that enthusiasm and all that motivation, knowing that they know the answer to everything else in the world. And they think they know commodities. And the logic of commodities is altogether upside down. What looks bullish in commodities is actually bearish usually. And they are so convinced of their rightness that it's really difficult for them to realize you have to relearn the whole logic of the world is not the logic of the markets, which is why most people lose trading the markets. They bring into the markets the same logic that they've been using every single day in their life, and it does not work in the marketplace. Because the public, the masses, can't be right. Think about that for a moment. If the masses were right, if we were all right trading commodities, what would happen to the world? Nobody would work. We'd all trade, right? We'd all be pork belly traders. Now that would be a very uninteresting life. So just the way it works out, we can't all be right in the marketplace, and the stumbling block that I see is this logic is just totally reversed. What looks like it should work in the marketplace using normal everyday logic isn't going to work. You have to reverse your understanding. And medicine and law is a very logical profession, A, B, C, subparagraph E, and you can't bring that logic into the marketplace. And especially if you have a real strong positive attitude. A guy I got to know a while ago, Tony Robbins, does a lot of motivational classes. And Tony said, boy, you're going to love my class, Larry. I'm going to give you so much motivation. You're going to feel so positive about what you're doing. I said, Tony, that's my problem. And I'm too positive about what I'm doing. I got to be careful when I trade commodities. You know, this is playing with fire. I can't rush in there with all this great, yay, super enthusiasm. That's the last thing you want to do. I mean, you need a little bit of that, but boy, you don't need too much of that, because then you'll fools rush in. And you do need to have a little wisdom so you don't rush in too much of this stuff. Well, so that's how you're going to make money, either small positions and large moves, or short-term traders, large positions and small short-term moves. That's how you make your money those two ways. And I'm going to show you how you can tell when those large moves begin. That's where you're going to get to out of this series of tapes. And then later on, if you short-term traders, we can show you how to do short-term trading as well. But it's better, I think, to start trying to figure out the long-term moves, because it's a lot easier to do. You don't have as much data. You don't have as many problems dealing with that. We have another term we need to work with, and that's open interest. And we're going to use this a lot to help us tell what the market's going to do. Whoops. Open interest. And to make it simple, let's just call open interest a reflection of volume. Open interest shows activity. We're just going to call this activity for now. It's a little complicated for beginners to understand. You can ask your broker about it if you want to. You can read some books about it. We're just going to call this activity. And later on, I'm going to show you how you can use open interest to tell when the activity is telling us to be a buyer or a seller. Open interest is important. I don't use volume very much. I use these figures a lot, the open, high, low, close, and I use open interest. Those are the primary sets of data that I get every single day from the marketplace that I use. There's some other terms that we need to work with. Let me show you what those are. We also have some terms called the market. People say that the market gapped, and let me explain that to you. This is the high. Yesterday was, say, 65. The low was 53, and it closed at 61. The next day, the market opens up here for some reason. There was a tremendous amount of bullishness, and the market opened at, say, 67. So while it closed last night at 61 cents, because this news came out, there was a gap in the market. So we'll call this a gap. If you hear people refer to a gap, you'll know what it is. It's the price difference between the close and the next day's opening. This case would obviously be an up gap. If it opened down here, it it would be a down gap. I found these gaps are tremendously important. They're very valuable trading information we can glean from these gaps. I use gaps a lot, as you'll see in some of my patterns. Some of the strongest work that I use involves gaps. So when I talk about gaps, you'll know I'm talking about the change from last night's close to this morning's opening, whether that's a higher opening or whether that's a lower opening. Interestingly enough, most people, if they call up, say, their stockbroker, they'll say, how's my stock? And the stockbroker may say, well, your stock closed today at 60 cents, and yesterday it was at 59 cents, or $59. It was up $1 for the day. Up $1. That's the way the public looks at the market. I don't look at the market that way. I look at where the market opened that day. Let's say the market opened at 63 and came down here to 60 and closed at 60. While it was up for the day, it was way off of the opening. The professionals in the market, and I'll show you how we're going to measure that later on, the professionals look at the opening versus the close as opposed to the close versus the close. The public is looking here. You great unwashed masses out there have only seen this relationship, close-to-close relationship. And I'm going to show you that this is the important relationship, the opening to the close, where the market opened and how it finished. Because every day is a battleground in this business. The market opens and then the battle goes on. Somebody tries to move the market higher, somebody tries to move the market lower. How's the battle won? Is it won by those pushing above the opening or those pulling down below the opening? That's the battle that's important, especially for short-term trading. Tremendously important. It's one of the most profitable things I've ever done trading, using that opening price. So we're going to work on the opening price, and that's why it's important you understand that there's gaps, and we're going to look more at the relationship of the opening to the close than the close to the close. The professional viewpoint is opening to the close. Today's opening to today's close. The public viewpoint is what's the net change from today to yesterday. They're not even aware of an opening price. Most of you watching this videotape at home for the first time probably say, gee, I didn't even know there was another set of data, an opening price. You maybe only knew there was close to close. Maybe you knew there was a high and a low for the day. But it's the opening that's so important that we'll get into for entering the market, timing our entry trades, and also for showing when a market's under accumulation distribution. There's a question here, please.
Larry, is there some special term for that relationship of opening to close on a given day?
No. There should be. We should have a name for that, but nobody's come up with it. I guess would call it GORP or something, the gap from the opening and the range or something, but no, there really isn't. It would be nice to have a term, but it is an important consideration to look at in the marketplace. And thanks for the question. Again, if you people have questions, feel free to ask them. And you people at home, if you have questions, I'll tell you a little bit about how you can ask questions to me as well. I will do that in the start of the second tape. Okay, I think that may be all of the data that we're going to be looking at least initially. There are different ways you can give an order to your broker, and I'll tell you what those ways are. We have terminology we use when we call a broker up. We'll say buying on a stop. I told you what that is earlier. If the current price is here and we want to buy up here, in other words, we want to see the market prove itself by rallying up there, we'll call that buying on a stop. If we think the market might drift down a little bit and then go up, and we want to be a buyer down here, we'd say, and let's say we're going to give a specific price, 60 cents. Here, we want it to come down to 57 cents. We'll say buy at 57 cents limit, or you could also say or better. That tells the broker your order is below the market, that it must come down to that price and you'll be filled there. Whereas buying on a stop says it must move up to that price and you'll be filled there. The only other order you need to consider is if you want to buy it right now, you'd tell the broker you're going to buy it at market. If you hear yourself using this order a lot, at market, buy it at the market, you're probably doing the wrong thing. This is a very nervous order. This is the order you're just telling your broker get you out. Or get you in so quickly you haven't even thought about it. You're just get. A broker told me the other day, somebody called him up and he said, Get me out. And the guy said, well, what contract? What are we trading here? Oh, but you know what I'm trading. And the broker said, I don't know what you're trading. You got 4 or 5 positions. Well, that one. He said, which one? He said, the bond market. He said, okay. He said, how many are we selling? What? All of them. So you need to know, if you're doing at the market, you're probably way too emotional, and you've got to control your emotions. I almost always buy on a stop. I want the market to prove itself. I'm a chicken. I want somebody else's money to move it from here to here to prove this market is really going. Because if I'm having the market come down here, then it's coming down, isn't it? What is. What is it coming down. And I'm trying to catch something that's falling. And my experience is I'm not strong enough to catch these markets that are falling. Most of the time, they keep falling. So I buy it at 57 cents, and the next thing I know is down here at about 50 cents. And then pretty soon it's down here at 40 cents. I don't know what to do. Here at least I know it's come up here, and I've got some base down here where I can place my stop and say if it falls down, I'm going to get out of this trade. But to just buy weakness can be really dangerous. If there's a rule I could give you, especially starting out, don't buy weakness, buy strength. Let the market prove itself to you with somebody else's money that your idea that the market might rally is correct. Somebody else already rallied it for you. And you don't have to put up that money. Yeah, you're not going to make that money in there as well, but you've got some evidence, some hard, fast evidence from the universe of trading commodities that this market is now moving up. Whereas if you want to buy it and the market moves down and you're buying weakness, there's no evidence at all that the market might move up. In fact, the evidence is the market's moving down, and you want it to go higher. I don't want to disappoint you people, but the market doesn't care too much what you think is going to happen. I can see some of you have encountered that experience already, right? Yeah. So this way we can at least say, well, the market's telling us that this should be going higher, and now I can take. So I'm usually buying on a stop. I'll tell my broker, buy on a stop, whatever that value is, and I'll show you how we get those values. And then he knows or she knows it means the price must go there. If I now have a profit in the market, let's say the market's done something like this, and I bought here on a stop at, say, 60 cents. And this market's moving along, and for whatever reason, I've got a target up here to get out at 70 cents. I can tell the broker, exit or sell at 70 cents or better. Now, I can just give that order to the broker, and I can also say GTC. It does not stand for gentleman at all. It stands for good till canceled. Good till canceled. Now, that order will stay there until I tell them I don't want to use the order any longer. So the day that I actually make the trade, I can say buy here, exit at 70 cents or better, GTC, and if I want to risk on the trade, whatever this value is, say this value is 55 cents, I could also put a sell at 55 cents, also GTC, and my trade's done. Now, only one of two things can happen. Well, actually a third thing. The market's either going to go to 70 cents, or it's going to go to 55 cents, or I'm going to die and the broker's going to close out the trade. Those are the only three things that can happen. It's either going to go up to there, or it's going to go down to there. So I now have established all of the parameters of the trade. I have my target, I have my stop, and now the dice are rolled, and you got to see how they're going to turn up. So the GTC is an important order that you can put in there, and you can go about being whatever you want to do the rest of your regular business life. You can go back to practicing law or whatever your profession is. The trade's over with. Now the broker is assigned with the responsibility of monitoring those prices for you and getting you out when those prices go to those price levels. So you're through with the trade. And that's why I like to trade as opposed to being in the minutia. I've done so much of the minutia trading with quote screens and charts and all that stuff around me. It fits my lifestyle to trade like this. Buy it, place your target, place your stop, walk away from it. Trade's done. Then you can get back to something that you'd rather be doing, or at least something with a lot less pressure in it. And most brokerage firms have nice little brochures that explain all these terms. If the terms aren't totally clear to you or you have some questions about them, don't ask me. Please, ask your broker. They've got some great little brochures that the exchanges print up. They'll send them to you. They're free. They explain all the terms, and there's some more terms. The ones I'm teaching you today are the basic terms. But the books are there, and you can get them from the brokers. And if you're unclear about the mechanics, don't bother me with that. Bother me with questions about the market. That's not a bother, because I enjoy answering those questions. But answering questions about the mechanics of the market, that is a bother for me. Ask your brokers those questions. Let me tell you about who the players are in the marketplace. This is who's in the pool swimming here. We have people known as technicians. We have people known as fundamentalists. You'll hear another term, which is speculators. And then you'll have commercials. You'll have floor traders. And you may also hear on floor and off floor. I'll briefly define these. Technicians are people that keep charts, probably, or computers anymore. Technicians use charts and computers because they're looking at primarily just price structure alone, thinking that we can divine the future of the pork belly market. If we sit here and study this chart long enough, we can say, oh, this is going to happen because some relationships in the price. That's what a technician does. A fundamentalist doesn't look much at the price, but a fundamentalist friend over here is going to look at how many hogs are in existence right now? What's the birth rate of the hogs? Is bacon a popular thing to eat right now? Or is it not popular? Is there a disease in the crops? What's the price of corn? Looking at the fundamental price supply-demand relationships. Speculators are just kind of what the word stands. That's people who are just stepping in the marketplace and trying to be buyers and sellers. Commercials. This is the big word right here. We're going to get into this in tape 2. These are the guys with the brains. They've got the money. These are the people that use the commodity, and I'm going to teach you how to follow them, how to know what they're doing. And we're going to follow and mimic what these guys do. Floor traders are people who are on the floor, and they're filling our orders for us down there, by and large. Floor traders usually have the desire to go off the floor and trade upstairs or off the floor, as we do with maybe a chart book or a quote machine. Some of them would like to trade on the floor. Now, a guy trading on the floor has a totally different parameter than you off-floor traders. The guy on the floor is trying to get maybe 1 tick or 2 ticks in a market. In other words, just a minimum price fluctuation. If you get 2 of those, he's happy, he's done. Whereas an off-the-floor trader needs a bigger move than that. The on-floor trader, since he isn't paying commissions, or he's paying maybe $1, something like that, because he owns a seat there, he doesn't need much of a move. And he's just going with the flow of the market. He doesn't know anything at all, and at the end of the day, he shouldn't have any position. He should be flat. He's just going with the swings of the market as he internalizes them in his own gut. An off-floor trader, though, is trying to catch a bigger move. But you'll hear those two terms used as well, on-floor and off-floor. The trading styles would be the technician is using charts or computers. The fundamentalist is using some math, probably, and looking at supply-demand relationships. And the other trading style is emotions. Just feels right. And sometimes that's not a bad one. In the early 70s, one of my students said, Larry, I had this dream last night. In my dream, these people were wheeling in big loads of silver dollars to the bank in Salt Lake City, Zion National Bank. He said, so I'm going to go out and buy silver dollars. And he did, and then silver took off. So it was a great system for him. He's been going to bed every night since, trying to get more dreams. And there is an emotional aspect to trading, and some people want to trade with their emotions, or their feel, they call it. And some people want to trade with systems. So you could be a feeling trader or a systematic trader. I think the best is kind of a combination of both. I think systems can be of great value, but I think they're limiting too, because the markets change as well. So you need to have a system and think. That's what I do. That's my basic approach. Well, let's talk about your trading style for a little bit. This is really important because one thing I've noticed now in doing this video series is a lot of people try to be Larry Williams. You can't be me, and I can't be you. And there's this great popular concept out there, I'll model somebody who's good. I'll be just like them, and I'll be as successful as they are. And that's a very popular thing right now, to model. And I thought that made a lot of sense to me. But you know what? I read a real interesting study. They're going to do a modeling program of the great quarterbacks to see how they threw the football. So they really knew how to throw it. And you know what they found out? The one common thing about the great passers in the game of football? The one and only one thing they found out was that there was nothing in common amongst any of them. It's the only thing they could come up with. And I think that makes a lot of wisdom, that you can't fit yourself into somebody else's model or mode, because we are all different. My experiences are not your experiences. You certainly, heck, don't want to model me if you don't like risk, because I have no fear of risk. That's my biggest problem in the world. I'll walk into anything. I don't care. You know, I for some reason, don't have much fear. I wish I had it. I don't. So you don't want to model that part of Larry Williams at all. So you have to figure it out yourself. And I can tell you some things that might help you figure out your trading style. And I would say the first thing you need to decide is, how do you make your decisions? Does it take you a while to come up with an answer? Or are you just real quick like that? You know, like I have some friends that say, boom, 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 boom. They've got answers like that. That's not me. I'm kind of a plotter. In athletic events, I wasn't a sprinter. I was a quarter miler, and now I do marathons. I mean, that tells you how I think. How I can physically respond to something is I like to think about it a little bit. Whereas I know to be a real good day trader, I have to tell myself, I just got to be pop, 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 pop. I can't think. I just got to react and do it. Some people can't do that at all. If you're going to be a long-term trader, you can't be going boom, 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 boom every 3 or 4 minutes, can you? That won't work at all for a long-term trader. I know a guy who says he's a long-term trader, but he's rolling over his account about every 3 days. And I said, and this guy's a farmer. I said, if you planted your soybeans, would you go out and look at them 2 days later to see if they'd sprouted yet? He said, no, you'll kill them. So, well, same thing if you're a long-term trader. You don't go out and dig them up, every 24 hours, or, well, in case of short-term traders, every 15 minutes or 5 minutes to see how they're doing. You can't do that. You just have to kind of let it sit there and let it come to fruition. Whereas that's the strategy a long-term trader needs, one of kind of sitting back and letting it be. A short-term trader really has to be on top of things. So it's how do you respond to things? You look at your athletics that you've done, how you respond to things, how you deal with your children, how you deal with your business, and then you might have a sense of, oh yeah, I'm kind of moderate. Maybe my average trade should be 10, 15 days, or I like 60-day trades, or boy, I want to come in and boom, 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 boom. The other thing I've noticed, and this might help a little bit, I think the younger you are, the more you can short-term trade. We have more energy, you're more focused, you don't have kids and soccer and all these other things going on in your life. You can really put the blinders on and do it. I don't do a lot of short-term trading now. When I did, I wasn't a very nice person then either, I should point that out, because I didn't care about anything. I didn't care about anything but the markets. And I was really focused, and I made a lot of money. And it was great to make a lot of money, but nobody knew who I was during that time period, and I didn't know who they were during that time period, because all I cared about was the markets. Especially here in California, I'd be up at 4 in the morning and probably go to bed at midnight, and all I was doing was the markets, man. I was the best in the markets that there was for a time period at least. And then I realized it was kind of, I made a lot of money, but it was pretty empty too. There were a lot of things I wasn't getting out of life that I wanted to get, so you need to look at that side of the equation as well. And that kind of fits with your lifestyle. If you live in the East Coast, it's going to be a lot easier for you to trade the currencies. Here in California, they open at 5:20 in the morning. Now, there's not a lot of people that can roll out of bed every single morning at 4:30, 4:45. Or maybe you can, but your spouse doesn't want you to. So you have to, how does this fit your lifestyle? Where do you live? I have people that trade from Saudi Arabia, from Japan, from Australia, and they trade based on their time frame, when they can get up and when they go to bed and how it fits them. So you need to look at that as well. What's your lifestyle? Where does this fit into your lifestyle? You need to seriously address that question, because you can't trade outside of your lifestyle. I now know exactly what my lifestyle is, and I trade within that lifestyle, and I have a lot more fun living now than I ever did when I was trading without looking at my lifestyle. I'm very much a lifestyle entrepreneur. I want my lifestyle first, and then I'll make money to support the lifestyle, as opposed, I think it used to be, let's go make money and then we'll find the lifestyle. Well, I know my lifestyle, and then everything else is based around that. So you might want to look at what your lifestyle is, what your waking hours, your working hours. Most of you probably aren't trading commodities full-time right now. You've got a job. Is that right? Right. Some of you do, some of you don't. We have to work around that too. Because I know when I first started trading in Portland, Oregon, we didn't have quote machines back then. There was a clock. I was trading stocks, and this bank had a clock, and it would show the time, the temperature, and every 15 minutes the Dow. And my boss always kept finding me. I'd open up the window, I'd look out to see what the Dow was doing. That was my first quote machine. And, my boss kept seeing me do that. Obviously he was a little upset. I wasn't working. I was looking out that window to see what's happening, keeping my charts and stuff. So you have to find something that's compatible, that doesn't interfere with the rest of your life until you get to that point and say, hey, I got this thing knuckled down. I can do it. I can trade full time now. But develop it, phase this into your own lifestyle. Don't go out and try to alter your lifestyle. Make this work around you, and then you're going to be a lot more successful. You won't have all the pressures, for one thing. You won't be trying to look out the window and make certain that the boss doesn't see you. And I think that will help define what your trading style is. Well, let's talk a little bit about greed and fear, and then we're going to take a break and come back into trading the markets. The two compelling things that traders have going are fear and greed. Those are the big emotions that we always have, and I want to talk a lot about those because until you understand fear and greed, you're not going to be a good commodity trader. And my goal is to make you a good commodity trader, the best trader I can make you. And if you don't understand those two emotions, you're not going to maximize your potential. I want to first talk about fear. Fear keeps us from doing things. That's the purpose of fear. God gave us fear so we don't rush into the lion's den when the lion's inside there. In other words, we should be afraid of things. Fear blocks us from doing things. That's what you need to know about fear. It's a blocking mechanism. It blocks us because we have anxiety about an unknown event occurring. So we need to reduce our anxiety to get rid of this blockage. And you can reduce your anxiety in this business real simple by having stops. Saying every single time I have my trade, I'm going to put in how much money I want to risk, and that's it. That's all that's going to happen to me. I'm not going to lose much. I might get some slippage of where my fill is, might not be my exact price, but I've limited my risk because my stop is in the marketplace. So that's something you can define right. I know how much I'm willing to risk on a trade. I'll bet you people do too. And if anybody has a lot of fear, it's because you haven't assigned your risk and said, that's it, I'm not going to lose more than that. So to overcome fear, if fear is not getting you into trades, just say, this is my maximum stop loss, that's my stop, it's in the market, that's it. And you've now controlled the risk element, and you shouldn't be blocked or hindered from trading. Question, please.
Larry, the proponents of options traders mainly, of course, cite the fact that you can place stops, but of course in a fast-moving market, it could blow right through it and you're going to lose everything you made that year. Now, being that you've been in the business 30 years, I've always wanted to ask, how reliable are the stops? I know you have some slippage, but in your whole history of trading, how many times really would you say you've got hurt that bad where you wish you might have had an option?
One time. The propane experience I talked about earlier, I wish I would have had an option then instead of, because I couldn't get stopped out of the market because it was locked limit. I've seen markets blow through my stop, sometimes in the S&Ps by pretty good slippage. In other words, I'm not filled at the exact price where I wanted to be filled. But for my case, I would rather play that game than have 90% of my trades expire worthless. So while people who are selling these options to us will espouse that argument, my actual trading experience is the other side of the coin is I'm going to be in some locked limit moves where I'm long, and it goes locked limit. And that's the best of the entire situation. So I would prefer to have the opportunity of getting locked limit moves in my favor as opposed to being in an option that may actually lose value the same day the market's up locked limit. So I think that's the way I do it. Now, that doesn't fit for everybody, as I just mentioned earlier. You have to find your comfort levels. But like I've said, I've spent my life figuring out if they're going to go up or down. Somebody else can take that information and figure out how to use options on what Larry Williams knows. That's fine. I just don't have enough time to be good at both. And I want to be good at what I do. And so I put my attention on up or down in the markets as opposed to using options with them. But I can only think of one time where I wished, heck, I would have been in options. And the other times I've lost money, I would have kept buying options anyway. I can think of a time when I lost about $3 million trading cattle. And I wish that I wasn't in that trade, but I know I believe in it so much I would have bought options all the way down too. It wouldn't have mattered. I would have bought them and they would have tapped out worthless as well. So I hope that answers your question for you. Okay. So fear is the blocking mechanism, and what I found was what most people are afraid of taking? The winning trades. Isn't that something? You're afraid of taking the winning trades. I know what you people are afraid of. Your fear is taking the winning. You love to take a losing trade. And it isn't that you want to take the losing trade, it's that the losing trades look safer. The winning trade's like, whoa, either it looks too easy, the market can't be that easy, so I'm not going to touch that. I'm going to get over here because you got this one all figured out, and that's a losing trade. So if you feel fearful about a trade, that's the one to take. If there's any emotional rule I can give you, and that you're all laughing, you know it. You know, how many have looked at winning trades and you're afraid of them? Could you raise your hands? Yeah. It's the winning ones that are hard to take. But if you know I'm going to place my stop, that's it, I have my absolute stop, now you're protected. Now you can say, I can take that trade that scares the bejeebers out of me. I can take it now because I am going to use a stop, period. So by controlling your risk, you can get rid of your fear. Fear is you got to be really, you can't let fear block you in this business. Now let's talk about greed. Greed is the worst emotion. Greed is much stronger than fear. I know that because I've held on to my losing positions too long. You know, how many people have held on to losing positions too long? All of us, right? Every single person here has, if you traded at all. Because you keep hoping. People say, Larry, what should I study to be a good commodity trader? And I finally figured it out. You should study religion. Because every trader I know at some point in their life says, oh, God, help me. Because they're too greedy. They keep holding on, holding, hoping it'll come back. They're going to go to church 3 or 4 times a day if need be. You know, whatever it takes. They're going to make donations to charities, anything to get those markets to go back to where they were. Because you're just too damn greedy. And by the same token, after the market's had a nice move, you're too greedy again. You want it to go higher. And you don't get out when you should get out because you think, one more up move and I'll be able to get whatever it is I want. You're too greedy. So we have to learn to control greed. And since it's a more compelling emotion, it's a more difficult emotion to deal with. Fear, simply place your stop, and, that's what you're going to lose. You pre-assigned your risk. But greed, probably the best way to deal with greed one of the best ways is this. When you bring out your calculator and you say, I've got 6 contracts times $500 each that I've made. Wow, I've made all this money. Speed dial your broker. That's the high. When it's like those old movies where the bank robbers say, hey, Willie, one more bank and we're going to retire. That's the bank they get caught robbing, right? Same thing in trading commodities. You get that price that's up there and you think, oh, this is great. I call it the King Kong feeling. Remember King Kong movies, both 1 and 2? When did they shoot King Kong? When he's on top of the Empire State Building with Jessica Lange in his hands saying, I got her, this is it, Fay Ray. And then they kill him. That's the end of King Kong. He dies. But at that instant, he had the world. And you're going to have that feeling trading. You're going to feel, man, I finally know how to trade. No, you don't. You know how to trade, you know how to get out. So speed dial your broker. Get out. Don't wait for that last move in the market. Have pre-assigned values. I'm going to show you how we set targets and how we have things to get us out. But don't get too greedy. Because the problem with trading is that you're never right. And this is an important psychological thing to understand. In this business of trading, I am never right. And I am convinced the human mind works on wanting to be right. How many people would rather be right than wrong? All of us, right? Yeah. You're never right in this business of trading. Never. If you're a doctor, your patient gets better. You were right. If you're a lawyer, you win the case. You were right. If you're a mechanic, you fix the car. You were right. You're acknowledged. You're appreciated. You were correct. I've been trading for 30-some years and I've never been right. I have never been right. And let me explain that to you. On my losing positions, I've always had too many contracts, right? And it was a losing position. On my winning positions, I never had enough contracts. And I never got out at the right time. So it's a very frustrating business. You're never right, and our mind wants to be right. It wants to get out at the high tick. You can't do that. Only guys that write books and sells newsletters can really do that in their newsletters after it's the fact. Nobody gets in at the exact highs and lows. I don't care if they tell you that, forget it. That doesn't happen. It's a tough business. You want to just take chunks out of the marketplace, and you have to realize that you can't be right, but you can make a lot of money. There's a difference between right and making money. If the goal is to make money, great, you can do that. But if the goal is to be right, you're never going to be right in this business. So by having established targets and points where you're going to take your profits, you're going to say, hey, I'm not going to be that greedy. I'm going to learn from Larry, greed kills. And then you'll know where to get out of your trades, and I'll show you how to get out of the trades and just walk away. I've got a lot of trades where I get out and the market moves higher, and I kind of feel like I'm glad that's happening. Somebody else is making some money there. That's my belief system. Somebody else is doing it, that's fine. I got out what I got out. I'm a happy camper. But if my belief system is, damn it, I didn't get out at the right point. Oh, I'm upset. What does that do to me? It gets me frustrated, it gets me angry, it gets me trying to get into the market again, doing everything wrong. So my greed syndrome is, I can't be right in this business, and I'm just going to suffer whatever I suffer, and I'm going to take the profits as the profits come along and be happy with those profits. Well, I hope by now you've got a basic understanding of the commodity markets, a little bit about how they work and how we work, who the players are, and what the data is that we're going to use to trade with. Because as you turn on the next session, we're going to see how we actually figure out who these commercial people I alluded to are, how we can track them, how they show us when the markets are going to go higher and lower, lots of things. So rewind this one and come back to tape 2, and we'll get into actually how to tell when the market's going to go higher or lower. For those of you that didn't watch the first tape, there are a couple of things on there that I think are important that I want to go over. But the most important thing, and you really should watch the first tape, the most important thing is controlling your potential losses by using stop losses. Now, this is an argument that's gone around for a long time. People are essentially afraid. This is really strange. People are afraid to limit their loss. They're afraid to use stop loss orders. They're afraid to place a stop in the market because you people are so paranoid that you think somebody's going to go run for your stop. Somebody on the floor is going to go get your stop. Is that right? Have any of you ever felt that? Let me tell you, you people are paranoid. They are not going for your stops. I want you to get rid of that idea. They're not interested in your stops. They're coming to get mine. And I still use stops. When I traded large, I'd trade a couple thousand bonds at a time. That means each tick is worth $64,000. So the market gaps up 10 ticks. You're not out of bed yet. It's $640,000. It focuses your attention. I consistently recall having the market go within 1 tick of my stop numerous times. I know in my commodity timing newsletter with my daily hotline that it's not unusual to see the market go to within 1 or 2 ticks of our stop and then turn right around. We had it happen in cotton this week. Our stop was 40 and went to 30. So it's not an unusual occurrence. If you're getting stopped out a lot, it isn't that they're going to get you, it's that your stops are in the wrong place. You don't know where to put your stops, and I'm going to show you where to put stops. So that's more important. You've got to use stops. Even if they are going out to get you, you still have to have them to control your risk. This is largely a game of risk control. The difference, I've interviewed winning traders and losing traders, and the biggest difference is the winning traders have risk control and the losing traders are religious. They're praying that they're going to get bailed out of this one. You've got to have risk control. And the other thing is I noticed about the winning traders, it's like athletics, like football. Those guys who are going to play football Sunday know they're going to get injured, don't they? They know they're going to get hurt, but they still go out and play. They know that that's the nature of the game. And that's the nature of trading commodities. You're going to have losses. You just have to try to control those losses. And I'd like to make a final point on the paranoia thing. When I was at a Buster Douglas, Evander Holyfield fight in Los Angeles a couple of years ago now, I was with a guy who was, that time was the largest bond trader in the history of the world. And he traded in the pit, Charlie DeFrancesco. And we're waiting, during the preliminary fights, we're trading on cellular phones, we're trading bonds. That shows you our reality. And I'm buying and he's selling. And he says, oh, it's you off the floor traders. You're going for my stops. I say, no, it's you're going for our stops. It's not unusual for people on the floor to call me and say, what's going on down here? Because it's such pandemonium down there. But maybe I can drive all this home the best because people are looking for these people that know everything. Several years ago, I was in New York City. My secretary reached me and she said, Larry, there's a banker from Switzerland who's trying to reach you. I'd like you to call him. And I go, oh, this is great because I want to find out what gold's doing. This when gold was hot. I'm going to call this guy and see what the gnomes of Zurich have to say about gold. This guy was with the second largest bank in Switzerland, head of their investments. So I called him up, and the conversation kind of went like this. Well, how are you doing, Mr. Williams? Fine. I said, you know, he said, well, Mr. Williams, we would like to hire you to tell us where the price of gold will go. You're going to hire me? I was going to ask him. They didn't know in Zurich. They're willing to find somebody like me. So I don't know that there's anybody that really, truly knows the be-all, end-all of the markets. It's just like football. You're going to get injured in this game. You just hope that you'll win a few along the way. There's always injuries out there, and you just need to control those injuries. We do that by using stops. Use them, absolutely. They've got to be there. If you don't trade with stops, you shouldn't be trading, period. If you're getting stopped out too much, your stop's just in the wrong place. It isn't that they're going out after you. It's just the truth about stops is really this. Most people place their stops too close to the market because they don't want to lose anything. And their stops are too close. I saw an advisory service advertising says, we'll show you how to trade with $150 stops. Well, I'll show you how to trade with a $10 stop. You're just going to get stopped out a lot. The closer your stops are to the markets have a lot of irrational, random activity, the more you're going to be stopped out. So my stops, they're quite a ways away. I love to feel that pain and agony of being stopped out because I know it's real. If they really come to my stops, that's a real move. It's not just some little gyration because somebody sneezed in Russia. That's something. There's a major change in trend has undergone. So my stops tend to be further away, and I don't get stopped out as much. When I get stopped out, my loss may be a little bit larger, but I'm willing to say, hey, I'm only going to risk $1,500 in my S&P trades. Maybe it's too big of a risk for some people, but that risk is the best to use in the S&Ps at this time. So I want a little larger stop. I don't get stopped out as much, and if I do get random activity, maybe it'll even get me out of my target and I can make a profit. So you got to use stops, and if they're too close to the market, you're going to get stopped out a lot. Okay, now let's talk about how we can predict where the market's going to go, and this is really the essence of what this course is about. The essence of what my 30-some years trading the markets are about is what I'm about to talk to you about. Remember in the first tape I talked about the commercials. Fortunately, the government reports to us the activity of participants in the market. Every other week the government tells us what the commercials are doing. They tell us what the large speculators are doing and what the small speculators are doing, we the people. So we have this report every 2 weeks. It shows the small specs, we'll call those for right now the public, the large speculators, large speculative positions, and the commercial. Now, I don't look at all at small speculators, and I don't look at the large speculators. I only look at the commercials. The commercials are the guys that really know the business. Their trading record is far superior to anybody else's in the game. Really, the way I've made money in the market on position trades is to follow the leader. It's a simple childhood game, and these guys are the leader. The commercials are the leader. And what I'm going to do is follow the leader. I follow these people. I watch them, I study them, I watch what they do, and they set up the markets for major moves. Now, some people don't like the fact that we get this information from the commercials. It's late. It's a couple weeks late by the time we get it. I don't care, because there's a huge difference between the commercials and you people and myself. The commercials accumulate over a time period and distribute over a time period. What we're trying to do is call the highs and lows of the day, or of a 5-minute bar. We want to get in and out, and we want to be exact. and they can't accumulate enough wheat to make shredded wheat and Cheerios and Betty Crocker's cake mixes in one day, can they? No, they have to accumulate over a long time period. So they tend to be early. They get in early, they get out early. They even get bearish too early sometimes, or they might get bullish too early sometimes. But that's not the point. The point is they show us when a market is getting set up for a trade. Now, they're not an absolute timing mechanism. This is what I want to make real clear. The commercials are not a timing mechanism. They are a setup mechanism. They say, this market's now getting set up. That's what's significant. We say, this market's probably now going to have a rally. Then we can bring in some other tools that say, and now's the time. But they establish what the future direction should be, and remember, they're early most of the time. So with that in mind, I'd like to show you some examples of commercial activity so you can see what their activity looks like, and you can judge for yourself if the commercials are as astute as I happen to think they are. Let me show you how I get the commercial data. You can get it on the World Wide Web under gov.cftc. I think that's, I'm not a real internet freaky guy, but you can get it on there. I think it's under gov.cftc. And it's a whole bunch of compilation of numbers. What I do is a little bit easier. I pay somebody, I think it's $75 a year, and they fax me every time it comes out the commercial position. And they've done all the math, and it's just so much easier. I get it every Friday. This one I just came through yesterday. This is being taped on a Saturday, and this is Friday's Commitment of Trader report. This is updated through 10/22. And you can see it's broken down into small speculators, large speculators, and the commercials. And remember, I only look at the commercials. These other guys don't mean anything to me at all. That's all I'm interested in. Now, given that, let's just take a market and we'll look and see. Let's take a look at Treasury bonds right here. I see that the net position, and this is what the next thing I look at, is the commercials are net short 19,460 contracts in the Treasury bond market. They've been selling there. Let's find one where they're long. Down here in the S&Ps, I guess that's no surprise to see that the commercials have been long the S&Ps, is it? The S&Ps have been going a lot higher. We'll try to find gold. Look at this. Gold, they're net long 26,678 contracts. The commercials are net long the gold market at this time. So I monitor this and watch how these commercials are doing. I come down to sugar. Sugar, this is the last week of October 1996. The commercials are net long 19,375 contracts. So I'm able to monitor their net position. Are they net long or are they net short, and to what extent? If I look at wheat, I see they're short 3,000 contracts. Soybeans, they're short a bunch, 73,000 contracts. Japanese yen, they're long 47,000 contracts. Canadian dollar, I want to sell this one short. They're short 52,000 contracts. So on my report, and this comes out every 2 weeks, I then can see what their position is, whether they're net long or net short. Now that's not just enough, because we have to put this in some perspective. And I'll show you the perspective we're going to put this in to see what we do with it. But at least you can see how it comes out. And the chart books that came with the course, you can call them and they can fax this to you, or the futures charts out of Florida will also fax it to you, and then you've got the numbers. You can look at them every week. You can also get them, in fact, this is a good time to do this, to how to give you some sources. I download my data every day from somebody called Genesis Data when I do download, and I put this into my computer, and Genesis number is 1-800-808-3282. I download into software called Supercharts, and this is Omega. And these guys advertise so much, I don't even remember their 800 number, but you'll see their ads in Investors Daily all over the place, all the magazines. This is the best software. You can download the Commitment of Trader data also from Genesis Data into your software. Also Future Source, and there's information on your videotape that came with this. You can get daily data, and I think they may now have access to it, and they do in their chart book. They have the Commitment of Traders reports in their chart book. So there's data reference sources for you. If you need to contact me for anything, the best way to reach me is 619-756-0421. My fax is 619, of course, 259-1331. And if you want to reach me on the internet, it is, or Larry, email, LarryWMS at ctiming.com. I'll leave that on for a little bit. This is the fax number. If you're going to call me, please don't call when the markets are opening, when the bonds open or when the S&P's open. That's not a good time to call me, because that's when I'm doing my thing of trading. Probably the best time to call me is any time from 1:45 California time, 12:45 California time, until maybe 3 or 4 in the afternoon. The next best time would be probably from 10 to 11. Sometimes in the morning I'm in and out or not there, and sometimes I'm not there. So if I'm not there, you're not going to get me. There's something I'd like you to keep in mind. There's only one of me, and there's a bunch of you out there. So when you do call, if you could just have your questions, because I tend to be a little rude on the phone. People will call up and they say, "Hi, you're such a great guy." I don't want to hear that. I want to hear a question. And they'll just say, "Well, I want to ask a question," and I go on, and I said, "What's your question?" "Well, I was wondering about," give me a question. So just have your questions ready. It's not unusual for me to have 100 phone calls in a day and 75, 60, 75, 80 faxes in a day. And I can't handle all that. So try to be as short and as brief as you can. And if I'm brief with you, please don't take it personally. It's just what I have to do. And unlike other people with video courses, I don't have any, little postgraduate students that are going to answer your questions. You get me or you get nothing. And I like it better that way, because that way I'm responsible for the answers. If you've got a question about my material, I'm the one who's going to answer it for you. There are a couple of brokerage firms that can answer most of your questions about brokerage, and at LFG they've also had all their brokers watch the videotapes, and they talk with me daily. So if you've got questions, you might want to ask LFG first. And they may be able to answer a lot of questions that are just perfunctory questions, and go right ahead and do it. You don't even have to have an account there. They'll answer the questions for you. But if they can't answer the questions, then come to me, and I'll do my best to answer the questions. I will get back to you, and if I'm there, I pick up the phone. Nothing I hate worse than you call. You know the guy's in his office, right? And you call, and well, he's in a meeting. That's a great popular excuse. If I'm there, I'm not in a meeting, or if I'm on a line, then you'll have to hold. But those are the best ways to reach me. We've just got the email stuff going, so if you want to reach on email, you can do that as well, and we can reply to you in that fashion. Okay. Let me show you what the commercials look like on a graphic or chart form. I've just picked markets at random. In fact, I think what I did is go through the chart book and get every single market. And we can look at all of them. You can take a look at what takes place here. This happens to be feeder cattle. It's kind of an inactive market. Not much happens. Remember how I said the commercials are long or the commercials are short? This 0 line right here represents that they would be neither long nor short. When it's above, they're net long. When it's below 0, they're net short. I marked off the area here where they were net long. Look what happens when they were net long. Look where we are. Market rallied. Look where we were. Market rallied for 5 months. Market got long again. Look where we were. Pretty interesting, huh? Now look, at this point they were very short. This little level right here, in fact, that's shorter than they'd been for a long time. And look what the market did. The market was right there. And the market came down. What do you think? Should we follow the commercials? And this is like in a nothing market, feeder cattle. I don't know who trades feeder cattle anymore. This is not like a big deal. This isn't like S&Ps and bonds. Well, I'm going to show you a lot of examples because I want you to see how consistent this is. And I'm going to give you some rules that we can do this by. Here's live cattle. It was just the next one in the chart book. And again, I've marked off when the commercials are long. Look what happens. We're there. We're here. We're here. And we're here, where they get net long. Gee, that's pretty good. When they are aggressively short, notice here they were real short down in here, shorter than they've been for a long time. Look where that market was, right here. Now recently they've gotten very short up in here, and look where we are. We had another heavily short time period in here, there, and again there. They were not aggressively short up there. They tend to be at the significant turns in the right position. Here's cotton, tough market to trade. Cotton's a hard market to trade. Look where they're aggressively, where they've accumulated their position in the marketplace. These are the only times since 1993 when the commercials have been heavily net long. And as you can see, each time that they've been heavily net long, we have had some decent rallies in the market. The smallest one from 80 to 88 cents, that's 8 cents times $500. What is that? $4,000 profit. Cotton got to the 66 cent area, rallied up to about 76 cent area. So those have been the small moves, and you've had some gargantuan move from 72 to over 96. Now remember, 1 cent from 72 to 73 is $500 in cotton market. Here we went from the 66 cent area to over $1.12. And here we went from the 56 cent area up to the 86 cent area. 30 cents times $500 a contract, $15,000 profit. So there's been some huge moves in this market, as you can see all the markets, that come about when the commercials are heavily long. I'm going to show you some more examples, and then I'd like to give you some specific rules that you can live by and trade by in these markets. Here's wheat. This is really interesting because in 1996 we had certainly one of the largest up moves in the wheat market that we've ever seen. But look what happened. The commercials went long. They got heavily long back here in January 1995, and look where the price of wheat was. And then we had a huge move all the way up to $7.40 a bushel. Remember, each cent is worth 50 cents. Each cent is worth $50 in the wheat market. So 360 to, let's call it 760. Take that number of cents times $50, and that's the profit in the trade. They were also, again, bullish in this area, right here, and wheat moved up again a substantial amount. So the commercials getting net long is significant. Notice, though, that they actually started to get net long up here. Remember what I told you, the commercials tend to be early? Absolutely. So the fact we get this information late, fine. I'm glad we got it late. Otherwise, I'd probably be getting the market too early. Let's look at another market. Now I'll show you a couple that work. This is soybeans. Soybean oil, different market. Again, I've just marked off when the commercials are net long. And I'll let you judge if that information could have been of value to you to trade by. Absolutely. The major moves we occurred in this marketplace. I don't know what we were over here. It's blocked off from being able to see it. The major moves, that's where we were. Now, the sell side is a little different. What I look at in the sell side, I like to see them heavily short. I'd like to see that they're, remember now, this is our positive line and this is our negative line. This is 0 right there. I would like to see the commercials at the most amount of short selling for the last 12 months. So we're way down over here. Notice this reading there, minus 400 or 40,000, 4,000. This is the lowest reading we've seen for all this time period, isn't it? Gee, that should be a pretty good sell signal in there someplace. Right about in here, we start to get our early warning selling indication that the commercials are now not only short, but heavily short this market. And right in here, they actually turn up. Oh, look where we are, right there. The last time we saw the commercials that heavily short, right there. And then prior to that, we saw them short right here. Gee, sell there, buy there, buy there, buy there, sell there. It's not bad. Let's see what they were doing. They didn't get heavily short at that high. Okay, let's look at some more. Again, these are just right out of the chart book, page by page in alphabetical order. Just there isn't any magic to this. I didn't just bring the only chart that's work. It's just we'll go through page after page after page to drive home the point to you how powerful these commercials are. Most people said, oh yeah, the commercials matter, and walk away from it. Don't do that. Look at these commercial figures like your life depends on it, because it does. This is the fundamental cause of major market moves. These guys know more than I know. They know more than you know. These are the people that we need to follow. Look what happened in soybeans. They started accumulating in soybeans in here. They completed their accumulation phase. It took them a long time to accumulate. Now this is a lesson you need to look at. The longer that they've been accumulating on the buy side of the market, the bigger the move you're probably going to have to the upside. Notice that they accumulated the heck out of soybeans, and then soybeans went from basically $5.50 a bushel to $8.20 a bushel. Again, 1 cent in soybeans is worth $50. You figure out how much profit's involved there, a huge amount. Finally, they start to get negative down here. We've got a 12-month low in short selling, and we get the first serious pullback in that market. Recently, now in October 1996, what's taken place is the commercials are not positive yet, but they're getting close to a 12-month high. And this is the next lesson I want you to look at. Notice we are negative. This is our positive, this is our positive, this is our negative. We are still negative. In other words, as you heard the figures earlier when I read them, the commercials are still net short. But, listen to this now, they're net short, but their reading is at the highest or smallest amount of shorting for over a year. So I will look at that alone as a bullish indication. It doesn't absolutely have to be positive, but clearly these guys have stopped their selling and they've moved over to the buy side. So this is an alert to me that soybeans, some point over the next month or so, are probably going to establish a low. I've got a 12-month high in buying or a 12-month low in selling as one of my setup rules. If you have questions on that, make sure you ask me. Notice here they started buying early, right? But look where our 12-month high came. Well, the highest high of the last 12 months came right there. Bingo, right at the low. So I'm big on a 12-month high or a 12-month low in the commercial activity. Here's gold. Remember how we said in soybeans, the more they accumulate, the bigger the move can be, or this is corn, I'm sorry. The more they accumulate, the bigger the move can be. And they finally then get very short over here. There's our first selling indication. And we have to be pretty leery about the market from here on, because the commercials have now been short, heavily short, for some time period, this entire time period. And the market tops. And I will show you how to fine-tune the timing. Notice again, they're very early. We'll fine-tune the timing. Now they've started accumulating corn in here, and they've moved now, as of this week, to the highest high of more than a year. So the corn market, as we talk in the last week of October 1996, is getting itself set up for a rally. The commercials are net long, right? And at the highest reading for 12 months. The commercials have been accumulating during this entire time period, have been accumulating corn. More interesting now, this is where you start to, it's tough to make mechanical rules. You've got to use some judgment. It's okay to think about things in life. What's happened to the price of corn? Corn's come down. Did that scare the commercials? They kept buying it. They bought all the way down. In other words, they're telling us they want this corn. They didn't back away from a declining market. In fact, they actually bought more. That's very bullish. Again, it doesn't say corn's going to bottom today or tomorrow. We still need to bring in some technical timing tools that say, okay, now we can get aboard this freight train, hopefully, and maybe we'll get stopped out and get back aboard the freight train. But it's getting set up now. This market is getting set up for an up move. Gold. This has been a real powerful market for the commercials. Notice when the commercials are long, where they got long here, 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 here. They stayed long for some time period here, didn't they? Biggest move we saw in gold. They got long here, nice rally in gold, and now they're not only long, but they're also at a 12-month high. Look at that right here. And what's gold done? Gold rallied. It doesn't take any great rocket scientist or insights into the future. All you have to do is follow these people. These people need to be followed. If we look at when the commercials are heavily short, here's a 12-month, 12-month, and there's a 12-month. So there's a sell, there's a sell, and there's a sell. You didn't think it could be that easy, did you? Yeah. We're all into the minutia of all this stuff. We're worried, you know, the Howard Ruff crowd is worried that the world's going to come to an end, and they want to buy gold, and the Keynesians say, oh, gold is a you know, worthless metal, it's garbage, nobody should worry about it. All those arguments, you can argue all those arguments. I spoke at one of those gloom and doom seminars. I said, I've got great news for you. The crash is coming. Boy, these people applauded. They were so excited. I said, in 2012. They booed. They want the crash now. Those people, given the choice of two disasters, want them both. And as opposed to getting into all those arguments about the end of the world, Bob Dole versus Bubba 2, which is what we're going to have here in November, it's irrelevant. What I'm going to watch is what the commercials are doing, because these guys need the product. These guys need gold. They need wheat or soybeans or whatever it is. And they know a lot more than I know. I can argue better, you know, than maybe somebody else can in my newsletter. I make a great argument for it to go higher or lower. It's totally irrelevant. These guys are going to make it go higher or lower. All these guys who write newsletters that pontificate on CNBC and all that stuff, we don't know very much. And we have no control over the markets. We have no influence on the market. Well, maybe our subscribers influence. If we all say go out and buy something, we influence for 15 minutes. But we can't accumulate for a long time period. And notice when they started their accumulation, look what happened here. They bought on the way down. Did it scare them that it was going down? No. Did it scare them they're going down here? No. They kept buying. And look what happened when gold started to rally. They sold the heck out of the rally. This big rally in here, they sold it. Bother them? No. They started selling actually in here. Well, they covered their shorts over here and here, though. They made a real killing on it, didn't they? And they probably got some shorts off up here, but they started their campaign here. So they're short in this area, and they're covering in this area. They did real well. And that's why I follow the commercials. When I grew up in Montana, my dad would take me deer hunting, and he'd say, you know, Larry, there's 3 deer up here. There's a fawn, there's a doe, and a buck. He said, and the buck, which is what we're hunting for, is probably maybe, it's an older deer, probably maybe a 5-point buck. So we got to be real careful. I said, how do you know all that, Dad? He said, well, looking at the tracks. He said, come here, son, let me show you. He'd say, now you can tell that's a big buck because a buck has what's called little extra hoofs back here, called dew hoofs or dew claws, and you'll see those in the snow. And that's a heavy animal pushing down. So you can say that's obviously a bigger animal, and the spread is a little bit bigger on a buck than it is on a doe. So you can see what's there. He taught me to learn the tracks in the snow of the animals. And this is what I learned, and my dad wasn't much of a financial type guy, but I always learned, you know, I learned things from my dad. Like, this is one thing, tracking deer. Well, these are the deer I'm tracking now. Just different deer, and you don't need snow. That's the nice thing about it. You live in San Diego. I like that real well. So these are the deer that we're tracking, and you can just go, and I'll stop this at some point, but again, we've got a platinum here. Notice the commercials never have gotten positive in platinum. They've never been net long. If they do go net long, that would be very bullish based on the past activity. So that's another way I look at the commercials, is let's look at platinum relative to platinum. How do the commercials act in a market? That's really important, because the commercials are a little different than, say, pork bellies and platinum or gold or whatever. So I will pay attention to platinum. If they get net long, boy, that's an unusual occurrence in platinum. I can still trade this by saying, well, gee, there's a 12-month high, even though they're net short, right? There's a 12-month high. And then I get to a pretty low reading up there, and we get another 12-month high here, and we get the same thing happening here. Then we get a 12-month low down here, and look where we are. Now we're close to a 12-month high in platinum. So even though it's negative, and see, that's a big thing. People feel, oh, well, the commercials are, a lot of people say, you can't do anything with the commercials at all. And they'll point to something like this. They've been short that market, and the market rallied. Well, it's where the commercials are relative to what they've done in that market in the past. That takes thinking. It isn't just programming. Most people that have looked at commercials have said they're looking at, are they net long or net short? Meaningless. Absolutely meaningless. Are they net long or net short? Means that people call me up and say, what did the commercials do this week, Larry? Did they go positive? It doesn't mean anything if they went positive. It actually may be negative if they went positive, at least on a short-term basis. Have they been accumulating? Have they been distributing? That's a question you need to ask. Let me show you. Let me try to drive that point home a little bit more here and see if we can get an example of this. That's silver. Silver, net long, net long, net long, net long. Look where they got net long. Net long, net long, and net long in here. Again, showing what happens when this is their highest level of selling right there for well over a year, right? Right at the high in the market. So I want you to look at those relationships, not are we above the line or are we below the line. Life's not that simple. You've got to do some thinking and figuring out. Recently we've gone net long just a little bit here. Now notice at this point we were net long and they switched to the sell side. Now since you're an educated group now, you know that just switching an on switch, off switch doesn't mean anything. Look what happened. It actually started to rally. As they switched to the net short side, it rallied over this time period. It wasn't until we got to an extreme reading, higher, more selling than the last 12 months, that we got to the top. The mere fact that you've rolled over actually may be an indication that now the market's going to really move as it goes into a negative mode. Because we know they accumulate. The fact that it goes from positive to negative, that's not what's telling us that the deal is on. It's what have they done over a time period. Somebody asked me about the Eurodollars earlier. What do I think the Eurodollars are going to do? And on one of the breaks I said, well gosh, look what's happened. The commercials have been long the Eurodollar. They were short in here. This was a 12-month. And look what happened to the Eurodollars. They came down now. The commercials have moved to the long side of the market more than they've been in 12 months. So someplace in here, the Eurodollars are probably going to have an up move. And the fact that in here they moved to the long side, they just switched the long side up in here, doesn't tell us it's time to buy yet. They actually went from being negative to positive right here. It just says, okay, the deal is underway. That's all that it is. I want to be real clear that just going positive to negative or vice versa doesn't have a lot of significance to it, because they now are starting the other side of that phase of accumulation or of distribution. Treasury bonds, another market. The low of the year is seen down here. Look at the highest reading we've seen in Treasury bonds for, gosh, this was like 5 or 6 years, occurred right there. And we have a high in Treasury bonds this year, and what do we see down there? The most short selling we've seen in Treasury bonds, again, for 3 or 4 years, right there at the high. So I want you to pay great attention and detail to what the commercials are doing. Recently, the commercials got very bullish in here, higher than they've been for 12 months, and look where we were. And bonds are probably going to go up somewhere in the 114, 116 area now. Nice move. Why do we know it's going to happen? Because of the commercial activity. Any questions on commercials? I know that some of you here in the room have followed the commercials for a while. If you have questions, feel free to ask them. This is the time to do it. Okay, you all understand. It's something you should watch. And you're looking for the highs and the lows in the commercial market. You know how to get the information. I have it faxed to me. You can get it on the internet if you want to, and it comes out every 2 weeks. And you're looking for 12-month highs, 12-month lows, areas of accumulation, areas of distribution. That's what you're looking for. And that each market is different. In fact, let's look at Canadian dollar. Remember when we looked at the data earlier, we said the Canadian dollar on the report we just got this week, they were substantially short. Well, let's take a look at the Canadian dollar. When the commercials got heavily long, it was in this time period, accumulated here, 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 and now look where they are. They're down here at a 12-month low. Those of you who follow my commodity timing service know we went short in here last October. Why did we do it? Because the commercials were at a 12-month figure. We also went long back in here. Why did we do that? Because we had a 12-month high and a huge amount of accumulation in this Canadian dollar. Now we're down, you know, if I were to color in the other side of this, look where we are, we're like this. Interestingly enough, the technicians say, well, we've had a big price breakout here. This market should do whatever technicians think that it's going to do. It might. May well. It ain't the way to bet it, though. The other thing my dad always said to me, he says, Larry, he says, the fight doesn't always go to the biggest, toughest son of a gun that's out there. He says, but that's how you bet them. And by and large, he's right. You know, winners win. And what we like to do as speculators, the thing about Americans that I love, we're all for the underdog. We always want to be contrarians, really. So we kind of want to buck these guys. Sometimes you can't. You just got to, what is. You got to go with what is. So while this may look technically very positive, I'm saying, okay, it's getting set up for a sell. This doesn't time the absolute entry of the sell, but it's telling me it's about time. I got to pay attention to it. I do want to touch briefly on the other players in that marketplace. Remember, we talked about the commercials, and we also talked about the large specs. I'm going to draw out the line. This is the British pound. On the large specs is a dashed line. I'm going to tell you what the large specs are. So you know who these guys are. The large specs are essentially trend followers. They get positive up here when the trend is an uptrend. They tend to come in actually late sometimes. They are trend followers. Those are essentially the funds. The large speculators are trend followers. The difference is the commercials are trend enders. There's an old adage in the market, the trend is your friend. Have you heard that? Absolutely right. The trend is your friend until the end. But nobody knows when the end is unless you look at commercials. And they say, oh, these are the trend enders. These guys stop the market from going up and going down. So the trend enders, that's who I'm interested in, are the commercials. The trend followers, they're just guys that have a moving average system or something. They're just the trend followers. That's the large spec. That's why I haven't been able to glean anything from their activity. Maybe there's something you can learn from them. I just haven't been able to figure it out. Maybe you people can, but I haven't been able to figure it out. I want to get involved with these guys that have a pretty good record. Let's see how good the record is here in the British pound. This is a 12-month high, 12-month high, here, here, and here, and here. Now look where we are. We're there, we're here, we're here, we're in this area. They accumulate for quite some time period in there. Look at this nice accumulation in here. Pretty good points to buy that market. So the best thing I can tell you is pay a lot of attention to the commercials to help you set up the trade. Well, as I mentioned, just having the commercial data may not be enough because that just shows the market set up. And I also talked about the fact that the commercials can be early. And we want something that maybe fine-tunes this a little bit more for us. And we can use another group of players, if you will, in the market to fine-tune this more for us. And I'm going to show you that group. That group is the public. The public is the other side of the equation. Unfortunately, because not everybody has had the Larry Williams videotapes, the public is pretty bad when it comes to trading. Well, that's an understatement. They suck. And that isn't just, it's everybody, because we get our emotions involved instead of reality, and we don't know what to do. And the exciting thing for me to be able to teach this information is there's fewer people now that are having disasters in the market because they've learned about stops, about the commercials, about how to trade. And that's exciting to me to see that we can create winners in the marketplace, that you can be a winner trading. I've had so many of my students have become winners because they've learned to do the right thing, that we're getting a more of an educated public. What scares me about that is when there's, if everybody learns this stuff, then there's no public. But fortunately, there's always a public. There's always schmucks out there who think, well, the video, I wouldn't spend $200 for a videotape, and those same people will go buy a contract of gold because they don't like Hillary and lose $4,000, $5,000, $6,000 because they were smart enough not to buy some information. And the trouble with information in this business of commodity and stock trading, it's either worthless or you couldn't pay enough for it. It's absolutely worthless, it'll get you in trouble, or You know, it's something that you can use for the rest of your life, one way or another. Well, if the public is wrong, how can we go about measuring the public? There's several ways we can measure this group called the public. I can do it technically, and I'll show you how I do it technically by looking at open, highs, lows, closes, all that stuff. My good friend Jake Bernstein has a service where he calls up people every day, 50 traders, and asks, are you bullish on this market or bearish on this market? And that's a very short-term indicator of public sentiment, and it's pretty good for real short-term swings in the market. Jake had a real problem, though. Jake had a brokerage firm, has a brokerage firm, and one of the guys in the brokerage firm never had a winning trade. All of his trades were losing trades, lost all of his money. So Jake thought, would it be right if I lent this guy $20,000? Because I can make a couple hundred just doing the opposite of his trades. Yeah. That was you were the customer. No. Now we know. No. But that's how extreme the public tends to be. There's another measure. See, there's somebody that's even worse than the public, though. That's what was the good news to you. There's a service called Market Vane. And Market Vane has found the best group, the most incorrect group. And you can get the data from Market Vane. Let me give you their phone number. They have a hotline you can call, and you can get the, if you subscribe to it, they'll give you their measure of investor sentiment. And that's what I'm going to be used. This is Market Vane. And the charts I'm going to be showing you, what I call the public, and it really isn't, is the Market Vane Index of sentiment. This is something that Jim Sibbett started, 25 years ago now, something like that. A long time ago. Jim Sibbett, I think he's dead now. He's a great technician, a good guy, really neat man. And his service has been carried on. Like I said, they found an even more incorrect group. They found that the group that's habitually wrong, the newsletter writers at brokerage firms, those are the ones that have the worst record. So they monitor all that, the bullishness and bearishness, the newsletter writers, people like myself, and theirs is heavily influenced by brokerage firm letters. So we've got a ratio of what percentage are bullish and what percentage of those are bearish. And I'll show you an example of how the public, or what I call the public, investor sentiment works. Remember, when the public is real bullish, they can't all be right. When the public is real bearish, market's probably close to low. That's really all you have to learn. We'll just go back to a chart over here. This is the Canadian dollar. And we'll take, now the sentiment index is at the bottom of this chart. Notice it's over 75% right here. Let's see how the public did in the Canadian dollar. They were 75% bullish there, and they were 75%, over 75% bullish there. Kind of good, huh? Yeah. I love these guys. Invite them over to my house anytime they want to come. Just grabbing, we don't have investor sentiment for euro dollars, silver. Notice what happens. Again, we've got 75% bullish there. We're close to it there. We are here. Well, we're right there. We're right there. We're right there. We're right here. And here they got a little premature. Sometimes they can be early. Pretty good group. Now, the interesting thing to me, the public and the newsletter writers in silver are different than those guys who were writing about whatever our last market was. It's different guys. Here's the British pound. Different players in the British pound than in silver. Now we look at the public and we say, the public's real bullish there. Look where they're real bearish. Down here, down here, down here. Look where they were real bearish. Right here. Look where they got real bullish. Right there. Now they've since again moved to the bull side right here. That's why I know I've got to get out of my British pound pretty soon. We're long British pounds. There's some huge profits in them. I'm getting close to a target. Hey, I'm going to take my profit and move to the sidelines here because these guys have moved to an extreme position. When they're extreme over here, the market comes down. When they're extreme over here, the market rallies. So it's the zone, somewhere in that 75-25 zone is what I'm looking for. Actually about 65, 70%. If they're too bullish, I got to be really careful about being long. I sure don't want to be long. And then I want to be a buyer when I see them down in these low levels. Here's the catch, though, about this. It's so hard to follow these guys. Because when, I just randomly grab a chart, whatever this is, corn. When the public is way up here at the 75% area, as they are here, your emotions are going to be, oh man, I don't want to sell that market, because you're the public too. These guys are emotionally driven. When they're way down here and they're very bearish, when I had 25% were bullish, you don't want to buy this market either, because you are the public. There's a bit of the public in all of us. So we have this great fear. See, this doesn't look like the time to buy. Remember how I said the logic is turned upside down? This is when the public wants to buy up here. And this is when the public wanted to sell here. Because things look so bad, they want to sell. And when things look so bad in this business, that's great. I love famines. I love wars. I love disasters. I love droughts. I love all those bad things that happen because they make these markets move. And you've got to learn to like the opposite of what the public's doing. Here's soybeans. It's a huge crack in soybeans this year. Look where the public was, 75% bullish. Look where they were up here at the last. Look where they were over here. They were here, they were here, and they were here. Virtually everybody that I knew at this high in soybean market was bullish in soybeans, and nobody would sell them. And soybeans came down from what, 840 to 660, something like that now. Big down move. Now it's not let's look at the other side of it. Notice when the public was at their most bearish was right down here. 25% of them, in other words, 75% were bullish, and look where we were in the market at the start of this huge gargantuan up move. Guess what? They were wrong again. I mean, it's just, this is such an important group to follow. But there's a problem with the group that we also need to address. Take a look at gold. I'm going to put this in a different color ink so we can see what the public's done in gold. When the public got 75% bullish here, here, back here, and over here, look where we were. We were here, we were here, we were here, and we were here. Public had a nice record of calling the highs in the gold market. And when they get very bearish, look where we are, really here, over here, and we're not quite there yet. But we were in this zone for a buy, this zone for a buy. So I'd like to see this get down to that 25% area. The public is just washed out of the market. They're thinking there's no way this can go higher, and that's when the markets turn. Now, I'm not the only person smart enough to figure this out. Other people have noticed it. But there's also problems with this investor sentiment data because sometimes they're real early too. They get bullish, the market corrects, and then it goes to a new high, as you saw it doing wheat and soybeans. My contribution was one day I had this flash, oh, I just got real clear on these relationships. And I'd like to show that to you. The clarity that I saw was a betting situation. I can bet on the public or the commercials. Which one do I want to bet on? The commercials, right? And we've established that point. But the commercials can be early too. But what about when these guys are in total disagreement? Yeah. When these guys are long like crazy and these guys are short. That's the time I can say, okay, I've now got a setup trade. Or when these guys are short and these guys are long. That's my setup to be a buyer. And this is the sell. So I want these two crowds diametrically opposed to each other and hopefully at an extreme. I want the commercial so bullish and I want the public so bearish. That's the setup I'm looking for. That doesn't happen all the time, unfortunately. It doesn't even call the highs and lows. There's other highs and lows that can occur without this phenomena being there. But when the phenomenon is there, that's about as close as a locked up deal as you're going to find in the marketplace. It can still be early, though. So again, we have to bring in the technical tools to time us to get in and out of the market. But it's that juxtaposition of those two crowds, the commercials who are just wildly one way and the public goes wildly the other way, that's what sets up the optimum trades. That if there's any inside information in the marketplace, there it is, you got it right there. You want to get those two groups totally upset with each other. And then you got a deal going. And we'll look at some examples of that now. Well, here's our Canadian dollar. We talked about this earlier. Now notice, if you will, that at this point in time, the commercials were heavily long in here. And finally, the public, now they started getting long here. That's really pretty premature. And we said that can happen. Remember that? That's why people look at commercials and say, well, commercials aren't so good. And my point is, when these guys are long and at a 12-month high, they've been doing a lot of accumulating, and now the final ingredient is this. When at the same time the public gets very bearish, they're below 25% here. Only 25% of them are bearish. 75% are bearish, 25% are bullish. Now look where we are. We're right in here. Now you can throw a dart, you can buy an option, you can do a trend line breakout, you can do an oscillator, a whirligig, anything you want to do for your technical entry system. You can use the Beverly Jaeger system if you want to even. You know what that is? There's a lady in St. Louis, Missouri. She had a great system for trading the markets. I bought it. Cost $1,000. She claimed she'd made a lot of money. Her system was this. You get your chart book, you cut out your charts, you put each chart in an envelope. You mix the envelopes up so you don't know which chart's in which envelope. Hold it to your forehead. If it's warm, you buy it. If it's cold, you sell it. That was what she did. I paid $1,000 for it. She had a great track record. You could probably do the envelope technique, you know. What day to get in? Monday's warm, Tuesday's cold. Buy on Monday. So much stuff is there when you get this confluence, if you will, of the energy in opposition. That's what sets up your trade. Now the opposite side, finally these guys start to get pretty bearish in here, and the public gets, now we've got them in opposition right there. See how they've come together? Oh, we're at a high in the marketplace. Then these guys get the other side. They're all matching. They're opposed to each other. Then we have nothing going on here. Actually, the commercials are bullish in here at these points. And these guys are not down to 25% though, so we don't have an ideal trade. We finally get above 25% up here. Oh, look at the commercials. Da-da-da-da-da-da. They're right in here. They're real low, not as low as they've been for 12 months, but historically they've done a lot of short selling, and the public is 75% bullish. They ain't going to be right. So there's your sell point. Currently, we have a case where the market sentiment has the Canadian dollar close to 75%. It may have even gone there this week now. I check my numbers and see. And the commercials are heavily short. We've got a 12-month low in commercial short selling, and the public's at about 75%. I don't know, the Canadian dollar is going to come down for sure. I can't tell you that, absolutely, but that's why I'm going to trade it. Yeah, and there's too good of a relationship of these things over the years of getting these two crowds in opposition with each other to say, okay, now the trade is set up. And again, it doesn't mean pull the trigger today. It just means the trade is set up. Let's look at a couple more of these. Soybean oil. Here's the public down here. I'll mark their high readings. Ooh, look at this now. Ooh, that's exciting. 15% bullish down here. A little bit there, a little there. So these guys, at this point in time, the public is very bearish on the market. And I then go and say, what were the commercials doing? Well, the commercials were net long. Notice how the jaws of the alligator had opened up here, right? These guys have been long, these guys have been short, and where are we? Ta-da, low in the marketplace. Over here, the commercials don't get long, but the public's not blown out yet. Finally, that happens really over here. They're long. We've got the jaws have opened up here. We're at our 25%, and we're here and here. Then we get up above 75% here, and look where the commercials are. And look where we are. I mean, I feel like David Copperfield. You know, there it is, guys. You know, I mean, I'm not going like this with a beautiful girl, but this is commodity trading. I want a pork belly, not with a girl. I'm going to show some more examples to just drive that point home to you. So you see it. So much of what we learn is by repetition. If you see one chart, you say, well, maybe Williams has got something there. But you see a bunch of them, hopefully you're going to say, hey, there's something going on there. Question?
Larry, you said that bonds follow the Eurodollar, and I was curious if the public sentiment and commercial indicator in Eurodollar would also match or need to match that what's going on in bonds at the same time.
It wouldn't need to match. I like to trade each market on its own. Eurodollars may lead the bond market by maybe a week, 3 weeks, a month. So to use Eurodollar data may be premature getting me into the bond market. I want to look at the commercials and the public and the bond market to look at the bond market. That does raise an interesting point that I want to make, is that markets are different. People that trade the S&Ps are not the people that trade hogs. The margin of hogs is maybe $400, $500. The margin in the S&Ps is $15,000. So I ask, is that a different player? You bet it is. The predominant influence in the bond market is a lot of commercial activity. Is that different than people trading cattle? You bet it is. Markets have different characteristics. The same set of data that influences, say, pork bellies doesn't influence the bond market or the Swiss franc or the British pound. So I look at each market on its own because they are unique. They're just like people. They are unique in and to themselves. And some people, like my good buddy Tom DeMark, thinks he wants the exact same system for all markets. And I can understand that viewpoint, but if I can find things that give me a bias in my market, I'm going to use them, even if they don't mean anything to another market, if there's an intrinsic reason why they should be influential in that market. Well, let's look at wheat now. We looked at wheat and we saw that earlier we had a bit of a problem in wheat because the commercials have been short really for quite some time. The commercials got short wheat really this entire time in here. They have been short. But notice that the only times they got in opposition to the public, we had it here, we had it here, and we had it here. So I can refine and get rid of some of the bad commercials where the commercials are too early by waiting for the public to also get set up. Notice the commercial started buying here, but we didn't get our low readings from the public until in here. So I can use this as a fine-tooth comb, if you will, to get me closer to the truth. The commercials were pretty bearish early on here, but it wasn't until in here and here that the public finally was wildly bullish on this market. Same token over here, this entire rally, look at all this, the selling of the commercials. But it wasn't until here and another shot here that the public was at an extreme. I'm obviously stopped out of this trade with a loss. I come back again here, they're still short, heavily short. The public gets to an extreme, there's my second shot, and the decline unfolds itself. So part of the reason for using the public is to make certain that I'm not too early. Just the commercials being there may be too early. And by waiting for the public, I get closer, and I'm going to wait even a little bit more for the market to technically give me a sell signal or a buy signal. But for establishing a trade, for knowing anything about the market at all, if you just want to go to a cocktail party and be able to make sense and understand what's happening, you women want to know what's going to happen with the price of coffee or wheat or bread or whatever, you're going to get a great sense from here of, oh yes, this market is under accumulation and the public's on the other side, and that's what you're looking for. That's in my search of the market is the singularly most powerful element that I've been able to find to establish major moves in the marketplace, where you can take small positions and have a large move and make a lot of money. This is the if there is a surefire way of trading, this is the surest fire way that I know of getting these trades established and set up for major moves in the marketplace. And that's almost exclusively what I spend my time doing. As you can see, you know, the nice thing, as I've said about my stuff, is it's not very complicated. I mean, to do a Larry Williams trade, you just grab a chart and you say, okay, well, where are we? And you come over here and I say, well, the commercials are just slightly positive, and these guys are not at 25%. Next page in the chart book, please. That's it. I'm done. I've got my analysis done for the week. actually for probably a couple of weeks. So I like the idea of keeping it simple, as opposed to having all this stuff around me, fancy computers. I go in some guy's offices and they say, look at this. This, what he said, he had like 7 computer screens. He said, look how big that one is. I was huge like that, you know. And he said, what are you doing for quotes? And I had I have like a beeper that gives me quotes on it. I said, here's mine. You know, on the hour they send the closing prices of the British pound and the S&Ps and the bonds and the stuff I'm looking at. That's it. That's my quote machine. That's as complicated as I want it to be. Now that fits his lifestyle okay. That's what he wants to do. That's not my lifestyle. It might be yours. Then get into all the technology, because there's incredible technology there that's available now. But I'm saying you don't have to do it. You can do this as an avocation, as a hobby, and do probably as well, if not better, than this guy who's glued to the minutia on those screens. Well, let's look at some other techniques that we can use. I'm going to go back to my friends, the commercials, again, and show you how we use that thing I mentioned in the first tape called open interest. And I didn't really define open interest very well. I'm still not going to, because it just gets you confused. Open interest is a reflection of commercial activity, though. It reflects commercial activity. Important point, please pay attention. The commercials make up about 80% of the volume in the marketplace. And again, remember, open interest is a representation of volume. So the commercials are the dominant influence. They're about 80% of all the activity. So if the open interest starts to decline, in other words, there's less, it shows that there's less activity on the part of the commercials. If open interest increases, it shows there's more activity on the part of the commercials. Second thing you need to remember, the commercials are usually short. They're hedgers. The commercials are usually short a market. They're selling, they're hedging into their positions. So we know the commercials tend to be short. Therefore, if open interest increases, they're probably increasing their shorts. If open interest decreases, they're probably decreasing their short position. That's how open interest can help us. If open interest is increasing, the volume of the market is increasing. And since commercials account for most of the volume, and since commercials are usually selling, it's probably short selling coming into the marketplace. If open interest declines, it indicates the commercials are probably dropping their activity. And since their activity is usually what? Selling. It probably means they're buying, or they've at least stopped their selling. They're not aggressive short sellers. Now, the way that's going to work is if open interest declines like that, open interest down, that's bullish, with a caveat. If open interest goes up, that's bearish, with a caveat that I'm going to give you. The caveat is, this ain't always true, but in a trading range, when prices are in a trading range, prices have been coming down like this, and now they start to go in a trading range like this, and open interest starts to rally like that, I can say a couple of things. First of all, this trend is down, right? And open interest is increasing, so the commercials are probably adding to their shorts. So I would expect a breakout for this market to the downside, and I would want to sell a breakout or whatever technical thing you want to use. I would probably want to be looking for a sell signal. Again, the nice thing about my stuff, just flip the thing upside down. If the market is rallying and open interest is coming down, they're probably liquidating their shorts, and I would expect a rally to break out to the upside. That's the pattern. It's in your Money Tree book, in your Batting 800 book, so you can refer to that in the pattern. Now I'm going to show you some examples of it. I think that's what we've got here next. Let's just take a look and see. Well, we have Treasury bonds in a pretty well-defined trading pattern. Look what happens to open interest in here, and then look what happened to the bond market. Open interest declines. How much of a decline do you want? I'd like about a 30% decline in open interest. That's a rally for a sell and a decline for a buy. In this trading range, really open interest increased a lot in here. The market came down, still trading range, big peel off in open interest. This market is going to rally. Lo and behold, it rallied. Now what I love about this technique, this is something I first wrote about 26 years ago. In 1970, I wrote about this technique. I wrote about the commercials, wrote about all this stuff back then. Nothing's changed. Still at work in the marketplace. Crude oil. Let's see what's happening in crude oil. We had a trading range in here. Open interest pulls off in here. They've liquidated their shorts. Crude oil starts a big up move. Now notice in here that it's increasing. Open interest is increasing, but we're not in a trading range. The key ingredient, you must be in a trading range and then see the open interest do its thing. You've got to be, I want to emphasize this again, you must be in a trading range. If you're not in a trading range, you're in a trending market, I don't know what to do with open interest. I can't make anything out of it. I need a trading range to be able to get some knowledge and insight into the market. Here's crude oil. We're in a nice trading range in here. Look what happens to open interest. Gosh, what way are we going to break out of this trading range? Well, I'm going to bet to the upside. Why? Trading range market, it had been in an uptrend. Open interest peels off to the downside. Hey, that's a nice signal. It gives you some insight. It's like those tracks in the snow, the deer. It gives you some insight into the future direction of this market. British pound. Well, we're in a trading range in the British pound. Somebody asked me earlier, gee, that British pound trade Rindler, how did you know that was going to go up? Why'd you buy it? Well, look at this, guys. Look what open interest does in this trading range. Big peel off. Huge peel off in open interest. Then the market, actually the market went up this week to what, 160.40, something like that. We've moved up that far now. What tells us that? A, the commercials have been heavily long in the market, and now we get a pull off in open interest during this trading range. I better be taking buy signals in here. Canadian dollar. Now we've talked about the Canadian dollar right now. The commercials are heavily short. The public is heavily long. Look what has happened in open interest. A bit of a trading range in here. Yeah, this thing is starting to set itself up. Soybeans, a big trading range. What happens to open interest here? What takes place in the market? By the same token, in this trading range in here, open interest came down. Big flash flood rally in the soybean market. Again, we get back down in the same trading pattern or trading range. Open interest declines. In comes our rally. And again, to me, the most thrilling thing about this is 26 years of looking at open interest. To see it just as alive and well today as it was back then when we first stumbled into this relationship. Soybean meal. Soybean meal gets into pretty good trading range up here, open interest. Same trading range we had in soybeans, open interest declines, the market rallies. Now this is not as black and white or as simple of a tool to use as, say, the commercials, but it's going to help you a lot. Let's see. Trading range in here, downtrending market, open interest increases. Look at the increase in open interest in here, down comes the market. It's like classic book. It's interesting teaching this to so many people. I'll have people call me up and point out these things to my attention that I haven't noticed. Say, oh, did you notice, Larry? And I had a friend call me up this year for one of the big rallies in the grain market. We had a huge, he says, this is the mother of all open interest reductions. And it was, and sure enough, the markets went up. Nice little trading range in here. Open interest peels off dramatically in there. Up goes the market until open interest increases. Ironically enough, open interest is something that has not been focused upon much in the books, in the classical literature about this business, and their interpretation is totally different than mine. They want price up and open interest up. The thing, though, is the trading range. You need to put it in context of the trading range itself. You've got a trading range in sugar, a breakout to the upside, sold in here, so it was stopped out, sold again over here, and we covered our shorts, I think, down here. What got me negative was the commercials, the public, and also look what's happening to open interest in here. During really a trading range, even though we broke out to the upside, huge increase in open interest. I wanted to be short. Now, currently, if sugars move sideways in here, I'd like to see open interest start to peel off like this as we continue moving sideways. That would really, I don't know that that will happen. But if it did, that would excite me about this particular market. Take a look at a couple more. Lumber. Trading range market in here, look at open interest. Trading range market in here, look at open interest. Open interest comes down, trading range market, prices move higher. So this should be another one of your tools then that you should use. I'm going to give you actually 7 tools here. The first tool is going to be the commercials. Second tool is the public. Third tool is open interest, which is a reflection of commercial activity. Those are the first 3 tools. I'm going to give you a 4th tool now. This is spreads. I'll define spreads for you.
Larry, for the open interest, do you use the total open interest per commodity or the open interest per contract month?
Great question. When you look at open interest, you want to look at total open interest of all the contracts. We get volume for each contract, like the June, the September, the December, and open interest for those months, but you want the combined open interest and the combined volume. The reason being that you may be liquidating open interest in the nearby, but building it up in the distance. So look at the total open interest. Great question. I appreciate that. I get that a lot from people. Look at the total open interest, not just one individual contract month. Look at total open interest. Okay, let's talk about spreads. One of the great things about the commodity market, as I said earlier, is there's a relationships that we don't have in the stock market. Because we have, say, a January contract, a March contract, a May contract, a June, a SEP, and an October. Whatever this market is, doesn't matter. These months sell at different prices. The January contract typically might sell for, say, $4.80, whatever it is. The March may sell for $4.90. This is $5. This might be $5 also. This is $5.20, and this is $5.30. As you go out in time, what happens to price? Price goes higher, right? That's the way the markets are most all of the time. Reason being, whoever has that commodity for delivery next October, a year from now, has interest, storage charges, insurance, and the fear of the unknown, which is great in this business. So typically, markets in the distant months, we call those the distant months out there in time, sell for more money than the nearby contracts. That's the way the markets are. It's called, actually, a carrying charge. We have a term for that called a carrying charge. This is a carrying charge market. That's the way the markets almost always are. They're carrying charge markets because of those unknown and real costs of holding the commodity. On occasion, there's an inversion in the marketplace. And this whole carrying charge thing is inverted, and you get a market that looks like this. The January will sell for $5.30. The March for $5.10. The May's for 5 even. Maybe you've got 505, 490, and 460. Again, these are just numbers to make a case. Notice here, nearby sell for more money, don't they? Why would that happen? Interesting question. If my basic thesis, the underlying thesis about Larry Williams is commercials are what it's all about, because they represent 80% of the volume in the marketplace, somebody's bid this nearby contract to a premium over all the other markets. Who would do that? Would we, the public, do it? No. A, we don't have that kind of holding power, and B, we don't have that kind of money. You're talking about a huge force to have an inversion and go to what we call a premium market. This is a premium market when the nearby sell for more than the distance. What this means is somebody wants this market so badly they're willing to pay more for it than for the distance. That's very bullish. But like all this stuff, you need to know how to interpret it. So I want to first establish this point, and then I'll show you how we interpret this information. It can be interpreted in several fashions, but the first thing we want to do is look for, do we have a premium structure in the marketplace? That in and of itself is bullish. But there are several ways to read it, and you can just get your Wall Street Journal Investors Daily and look through it and see price of corn and see if you're at a premium. This is a premium market. Or you're at a carrying charge, at a carry. Or some people call this a discount. What is most significant about this is, if this is my difference between, say, the January contract and the March contract, I'm going to simply subtract, in this case, the January from the March. The March is at a 10-cent, the January is at 10-cent discount, isn't it? Whereas here, the January as a 20-cent premium. It's over the March contract. So we put a little plus-minus line. And in the case of the March, that was at a 20-cent premium, I would put it up here. And you plot this daily or weekly, whatever you're looking at. Usually, we're at a carrying charge market. We're below the nearbys are selling for less than the distant months. When this happens, when you get a cross, that's very bullish. At this time of the crossing, if there's an on-off switch, this is an on-off switch. When you go from a carrying charge to a premium market, that's bullish right then. That says this market's ready, it's in tighter hands. It's in commercial hands. This is not in the public hands now. This is the commercial market. This is a commercial bull market, in fact, may well be developing here. So you want to pay attention to that relationship, what we call spreads or premiums, or an inversion in the marketplace. And that's telling us somebody wants this so badly that they're willing to pay a premium for it, and we know who wants it so badly, the commercials, because they're the only ones that want the commodities. They want to take physical possession. How many of you want to have a bunch of cattle delivered on your lawn some morning? Probably don't, do you? Your wife's out enough problems that you're keeping a chart book. You know, let alone somebody knocks on the door. Is this the house where we deliver the pigs? You don't want that. But they want it. The commercials want it. So they want to take this and they'll buy it because they need it now, and they'll drive the market to a premium. As they drive that market to a premium and it goes positive, that's a very bullish sign, and I want to be looking at this point to be long this market. That's a bullish indication that I should be long this market. Now, what happens is the market may be coming along like this. It may even start to go up in here about this time period. You may not call it the absolute low, it doesn't matter. Then the market continues moving up, and people who've read my work will say, well, there's a premium in the market here, Larry. This must be bullish. And my point is, no, not necessarily now. It was bullish back here when the premium came on the board. But now we have to look at something else. The something else is, how is the premium doing versus the price structure right now? Notice here, we made a new high in price, but the spread is starting to fall apart, or it's deteriorating a little bit. So once you've had a premium, you then need to look at the relationship of the premium to the market itself to see the interaction. But it's this is the big thing that's very bullish, and it's a bullish bias when you've got a premium, but I still want to focus in on the relationship between the premium and the actual market price itself so I can monitor and tell what's happening. Typically what will happen, this market will come down like this, and the spread will do something like that, saying, gee, in the face of weakness, they wanted even more. They wanted that nearby contract even more. That's a nice buy signal, and this market will go back up again. So I will use the spread in two fashions to help me time entries in divergence between premium and spread, and to say, uh-oh, we're in a commercial bull market. And there's a big difference here between commercial bull markets and what I call speculative bull markets. We've got two markets here. Now notice both of these markets started at the same point, we'll call that A, and they both ended up at the same price, B. Is there a difference in how they got there? Sure. This is pretty wild, isn't it? This is a public bull market. This is a commercial bull market. In a commercial bull market, you buy it, dive under the covers, wrap them around you, turn the electric blanket on to 9 and assume the fetal position. And hold on. In the public bull market, you sell the big rallies and buy the big breaks. Sell the big rallies and buy the big breaks. They're different markets. They both get to the same point, interestingly enough, but they do it in a different fashion, and your trading strategy needs to be different. This market doesn't have a premium. When gold had its big run-up and silver had its big run-up 10 years ago, whenever it was, this is how it's traded. But there was never a commercial bull market. It was always public. There was no premium. At some point, we'll have a premium in gold in the next big crash, whenever that is. Maybe in my lifetime or my grandkids, whenever it comes. But there will be a premium. And that will tell you that's the buy and hold market until the premium falls apart. But you need to trade them differently. You need to say, what am I in here? Am I in a commercial bull market or am I in a public bull market? So there's a third way then of using spreads. A, when it goes from negative to positive, you're in a bull situation. B, to judge the strength of the market as you're trading it. And C, to say, oh, I'm in a commercial bull market. Or no, I'm in a public bull market. Different strategy. Different strategies necessary for those markets. Well, given that information, let's take a look at some of the spread relationships. Let me show you first what causes that, how that can develop. This is the case of October hogs versus February hogs. And notice the October contract is a lot stronger than the February contract, isn't it? Quite a bit stronger, huh? Makes new highs. This doesn't make a new high. Which month do you think the commercials wanted? They want the Octobers or they want the Febs? Yeah, they want the Octobers. They're really goosing this one up, aren't they? Whereas this is not doing it. Now, a third thing and here's the spread down here. This is our spread coming along here. The third thing I can tell you about this, and this is a real important insight, so I want you to listen up to this, especially those of you who've watched this tape before. It's this. Once this October goes off the board, what do you think is going to happen to the Feb? Now, the Octobers have been in a strong demand situation. Commercials have wanted it more than the Feb. Will they get back in and start to buy the Febs now like crazy? Probably not. Probably the deal is all over. In other words, they want it now, and the fact they're not pulling this one up with it means once this is off the board, you can sell this one short. To confirm that, you would want to look at Feb versus the next month out to see if Feb is gaining on the next month out, just to make certain. But this is one of the nicest situations you can develop, is when you get a situation where the nearby is strong and the distance don't come up with it, and this goes off the board. It's like, that's it, deal's over, game's done. You know, this isn't time out, this is the end of the game. The World Series is over. So look for that relationship as well. We currently had one in cattle developing. Let's see if we did, yeah, look at the huge difference that developed in this market. October live cattle, it just makes all kinds of new highs in here, huh? Now, if you happen to raise cattle and you want to sell or do some hedging, where are you going to do it? You're going to do it in the Febs, not the Octobers. And you're probably going to say, you know, when this OCC is off the board here, this is where I can do my short selling. Or if you're negative in the cattle market, instead of doing your negative stuff here, you'd be doing it here. And it's so clear to see that here, but we'll end up looking at it at the spread to help us also look at those relationships. But this is what it'll actually look like. You know, you think cattle is cattle is cattle, right? Rice is rice, wheat is wheat. That's true. It's the same protein content, same iron content of these animals as these animals. Everything is the same, except these are in more demand. That's different than a stock. The stock of IBM doesn't have that timeliness. Nobody needs to take delivery before Christmas. Here, somebody wanted the delivery of these October cattle. So you get in what we call a squeeze play, where you can actually be long the Octobers and short the Febs and make money, because these are going down and these are going up. So you can actually make twice the money if you're on the right deal. The guy who was my mentor, who taught me so much, Bill Meehan, just work squeezes. That's all he did. He'd just wait until he got a squeeze situation. This is a build me in market. He'd love this market. He would be long the Octobers and short the Febs and be in the squeeze play because the squeeze comes in this nearby, not in the distance. See, new highs in here, you just don't have it. So when this is off the board, this is where you want to be selling short. Well, in the last hour and few minutes, you've learned about the commercials, how to look at the commercials, how to look at the public. This is the integral part of the market. This is the most important part to help us identify buying and selling opportunities. It's not the timing part, and there's still a few more big guns I'd like you to see. We'll do that on the next tape. But if there's the heart of what Larry Williams is all about, is this tape. This is probably the first tape you should rewind and watch again, 2, 3, maybe even 4 times. This is going to tell us when these markets are set up. When you're through with this, then get on to the next tape where we'll talk more about setups and then how to actually get in the market to be a buyer or a seller and how to set your stops. So get on to the next tape, and I'll see you there.